City on this Thursday, December 5th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, Bitcoin reaching that major milestone. The digital asset topping $100,000 per token for the first time. The move comes after President-elect Donald Trump selected a pro-crypto choice to lead the SEC. Paul Atkins will replace outgoing SEC Chair Gary Gensler, who cracked down on digital assets after that 2022 market rout exposed fraudulent practices and sparked costly blowups.
Plus, U.S. stock futures, little change this morning after equities reached new milestones on Wednesday. The Dow Jones Industrial Average hit 45,000 for the first time, while the S&P 500 closed out its 56th record high, putting it on track for its best year since 2019. Investors now await the November payrolls for the latest clues on the Fed's rate path.
And Elon Musk heads to Capitol Hill. The CEO of Tesla and former Republican presidential candidate Vivek Ramaswamy will meet with groups of lawmakers today. It's all in an effort to slash $2 trillion from the federal budget. Last fiscal year, the government spent more than $6.75 trillion, with more than $5 trillion of that coming from Social Security, healthcare, defense, and veterans benefits, all of which are notoriously difficult to convince Congress to cut. Bitcoin hitting a major milestone as the digital token powers past $100,000 per token. Still moving to the upside here this morning. You can see on your screen here up over 7%. Joining us with more, we've got the founder of the Digital Chamber, Perianne Boring. Perianne, it's great to have you on this morning. There was this talk that once we hit 100K, we'd maybe see a little bit of selling at that psychological level. We're certainly not seeing that. Where does this rally go from here?
Well, I think we saw that over the past couple of weeks. Bitcoin has been kind of teetering between 94, 96, 97 for several days now. If you look at the order books, there's a lot of people, a lot of trades with orders to sell at 100K. So I think that played a big role in it taking several days to cross that 100K mark. But what do we think pushed it across the edge last night? And of course, you had some photos of our incoming SEC Commissioner Paul Atkins on the feed just moments ago. He was announced by the President-elect Donald Trump to be the next chairman of the Securities and Exchange Commission. This is very, very bullish news for digital asset markets. For many, many years, the industry has really been against significant regulatory headwinds by the SEC as well as the CFTC. Paul Atkins is one of our advisory board members here at the Digital Chamber. He's been on the front lines helping to address the regulatory uncertainty, the regulatory overreach by the SEC. So they're calling it the Paul Haul, which pulled Bitcoin across 100K. But just to answer your question as to where we could go, where is the price of Bitcoin going from here? And I don't speculate on where we think the price is going to be today, tomorrow, a year from now. I think in the long term, ultimately, it's infinity because there's only 21 million Bitcoin. And there's no cap on how high it could go. But I'll tell you what the models say. So there's a number of different valuation models that have the price of Bitcoin at between 111 and 150 this year, so within the next couple of weeks. And then the stock to flow model has Bitcoin at over 800K by the end of next year, the end of 2025. Mm-hmm. Of course, Bitcoin has traded 1 to 2 standard deviations above stock to flow over the past 2 halving cycles. But we are just starting to see just the implications of having a pro-crypto administration, Congress, SEC, regulatory heads, and getting all that cleared up is having a huge impact on bringing these markets back and the direct impact on the price of Bitcoin right now.
Perianne, as we're continuing to look at Bitcoin and watching this milestone be crossed, psychological as it may be, because it's a nice round number for us to think about, and then it starts the conversation of, okay, well, how high can it go from here? What, though, is it trading like? And I ask that because there was so much years ago, 2 crypto winters ago perhaps, around this thought process of Bitcoin needing to be a medium of exchange. It's clearly not that right now, at least in the lion's share of thinking out there, as it's taken on more of a store of value. So if this is trading more like store of value, then what other coins out there are you evaluating to understand and really kind of wrap the rest of the market's minds around being real mediums of exchange?
Right, Brad, and you make a very good point, and I would point everyone to the Federal Reserve Chairman's comments on Bitcoin yesterday. Jerome Powell just said Bitcoin does not compete with the US dollar, which is something we've been saying at the Digital Chamber for many, many years. I don't think that's a very helpful way to think about what is Bitcoin as an asset class. It's not a competitor to the US dollar. In fact, it's a tool that can help strengthen the value of the US dollar. Jerome Powell had said it's more of a competitor to gold. It's been called digital gold, or compared, described as digital gold. And I'd also point you to Michael Saylor's comments over the past couple of weeks in the public interviews that he's had, and the comments he's giving to the board of Microsoft as to why they should put Bitcoin on the balance sheet, comparing it more as a competitor to real estate and equities. So as a store of value, just as you said, and it's a digital capital, it's digital gold. It's a place to store your savings, your wealth for many generations, and it's really proving to be the technically superior asset to serve that purpose. There are, as you noted, thousands of cryptocurrencies that are in existence. There is a very big difference between Bitcoin, which operates on a proof of work consensus mechanism, and smart contracts platforms that operate on proof of stake or other types of consensus mechanisms that are really developing these smart contracts platforms. So I believe in a multi-chain world, we will see many different types of cryptocurrencies that are used in digital commerce. Bitcoin has really won that use case of being the store of value. The others are really competing to be that supercomputer for smart contracts. There's many competitors. We're not really sure which one's going to win out in the long run, but those are totally different use cases from a store of value like Bitcoin.
Perry-Ann, final 30 seconds. You are among the contenders to chair the CFTC, according to reports. Would you accept that role?
Well, look, I'll tell you right now, I can't comment on that directly, but there's really only 2 phone calls that I'm answering right now, and the first one would be from our Lord God and our Savior Jesus Christ. If he makes a call, I'm going to answer his calls, and if President-elect Donald Trump called me, I would certainly answer his call as well.
Perry-Ann Boring of the Digital Chamber, thanks so much for taking the time here this morning. Appreciate it.
Great to be here. Thanks.
U.S. stock hitting new record highs yet again. HSBC expecting a powerful rally in the of risk assets in the coming months, but there are several risks to the upside and downside that could change that outlook. Joining us now, let's bring on Max Kettner, HSBC Chief Multi-Asset Strategist. Max, good to have you here with us this morning. As you're thinking about some of the potential risks here that are both to the upside and downside for the market, what are most prominent that investors should be apt to keep in mind?
I think, on the downside, given that we are so bullish going into 2025, it's probably more pertinent to talk about the downside risk first. Clearly, the biggest downside risk that we're seeing is still on the rate side. It is that effectively, we don't think we'll be wrong in our view. It sounds stupid to say, but effectively, it's almost like we're going to be too correct in our view, that really we're going to see too strong upside surprises on the earnings front, on the top-down front. And that, of course, would bring yields up. It would perhaps call into question the Fed's cutting cycle. Can they cut further? Do they maybe even have to hike again? Does the terminal rate have to be much, much higher? And that, of course, would bring long-end yields higher. It would bring bond volatility higher. And that really would be, sending a couple of ripple effects across all the risk assets. That, to us, is by far the biggest risk because it is so incredibly complicated to hedge, because of course both bonds would suffer, but also credit, also equities, also emerging market assets, virtually all asset classes combined, with the only safe haven being the dollar. Now, on the upside and on the positive side, look, I think some of the things around deregulation, yes, of course, but I think on the upside, there is still this really powerful combination the next 2-3 quarters of pretty low growth expectations. In fact, earnings expectations for the S&P the next 2 quarters are just for like around about a 1% growth quarter on quarter, both for Q4 and for Q1 2025. And on top of that, low top-down growth expectations, still getting those rate cuts through. The Fed already starting to hint at perhaps starting to talk about the end of quantitative tightening. All of that is a fantastic setup. It's as Goldilocks as we can imagine, really.
And you point out, Max, that inflation risk is the biggest one, which is interesting in the context of the market's bullishness right now, sort of in part being based on the fact that the inflation war has been won. What will you be looking at heading into 2025 to really get a pulse on the state of inflation and the impact that will have on markets?
Yeah, I would look at things like super core inflation. Now, super core is, of course, the Fed's preferred measure of underlying inflation. It's sort of the most narrow definition of underlying inflation. That, however, is more likely going to decline in the first half of next year, particularly the first 4 months, mostly because we had these incredibly high readings in the first 4 months this year. So therefore, it's more likely base effects, things like vehicle insurance, that the resetting of that is not going to be as dramatically high as it's been in 2024 and also last year. That would bring super core inflation down. That actually is, again, another bullish factor for the next couple of months. I would say towards H2, when we're looking at a couple of other base effects that actually then would be driving inflation a little bit higher. And I would particularly point out inflation expectations at the front end. So short-term inflation expectation. I think about 2-3 months ago, I would have been much, much more worried about inflation because those short-dated, those short-term inflation expectations were significantly below 2%. They were already at 1.6, 1.7%. But what we've seen in the last 3 months is they've clearly gone up. They've gone up significantly to almost 3%. So at the moment, I actually do see inflation risks more on the downside for the next couple of months. H2, right, the second half might be bringing a bit more on the surprise side, perhaps on the hawkish side, but that is nothing which we should be particularly worried about right now, I think.
So Max, what does that mean for your outlook for the first half of next year for the S&P? How much more room do we have to run, if you can put a number on that for us?
Yeah, I think like the next 6-7 months, I think you can easily have 5-10% up. I think it's really, really supportive for equities. I think for global equities, we're really seeing sort of about 12 to 13% more upside in the next 12 months, so until the end of 2025. I think a lot of that could be front-loaded in the first half of next year, but I don't think it's just going to be the S&P. Within the S&P, I think there is really a basis for some of those sectors like industrials, a bit of like a mini re-acceleration there, but still liking tech here. I don't think it's just going to stop at the S&P, though. I think that Goldilocks backdrop with better growth, better earnings, re-accelerating growth, certainly against growth expectations and consensus expectations, that could be benefiting also other asset classes. Still things like high yield credit, perhaps even things like emerging market assets in the first half.
You mentioned that you like tech, but it seems like as well that there's going to be a longevity test that's faced with regard to the AI trade. With that in mind, is there another sector that you think could outperform tech despite all the weighting that has been thrust towards technology thus far?
Yeah, I think, to be honest, in the next couple of months, I don't think it is, am I buying tech or am I buying all the other stuff? So I don't think it's like, do I buy Magnificent 7 or do I buy the equal weighted S&P? I think it's more about tech and some of the other stuff, which could be things like, the industrials. When we look at the S&P, I think particularly US banks look great here. It's the financials, but in particularly the banks with perhaps hopes around some deregulation, but also with rates coming down, with volatility coming down, with already, some signs of a new capital markets cycle starting. That should be really favoring US banks over European banks. So it's not just okay, I want to get out of tech and buy the other stuff, buy industrials, buy banks, perhaps even buy some of the healthcare stuff. But to me, it's more about tech and complementing with some of the other sectors.
Max Kettner, thanks so much. Always appreciate you. Let's turn now to the Fed. Chair Jerome Powell saying Wednesday the central bank could afford to be a little bit more cautious as it makes decisions on interest rates moving forward, thanks to persistent strength in the economy. With us now to discuss, Gina Smilek, reporter at the New York Times covering the Federal Reserve. Gina, great to speak with you. Given those comments from Powell about the ability to be cautious moving forward, what does that tell you about what rate cutting is going to look like, not just in December, but heading into the new year?
I think the question is really about the new year. I think it's about what happens in 2025. As we saw in their most recent economic projections, Fed officials as of September had expected to make about 4 rate cuts next year, a full percentage point of rate cuts. And I think there are real questions about whether that's going to be likely, because back in September, what we know is that the Fed thought that unemployment was rising. They thought that the labor market was slowing pretty notably, and they thought that growth was cooling down quite a bit. And all of those trends have really started to reverse themselves. And so I think that is what Chair Powell was referring to yesterday. And I think that it really creates this question mark over just how much the Fed is going to be able to cut next year and just how quickly they're going to do it.
And so with that in mind, the expectations have sounded like we could be looking at maybe a cut once a quarter. But what is the data that potentially could throw that off? Is it something like if President-elect Trump gets in office and really prioritizes tariffs and that spikes inflation once again?
Yeah, so I think that there are sort of 2 buckets of issues here that are worth focusing on. The first is just, what is the economy going to look like? Independent of any policy coming out of the White House, we've already got an economy that is expanding much more quickly than economists expected. We have inflation that looks a little bit stickier, and we have a job market that looks like it has more resilience, if not momentum. And so I think that combination suggests to the Fed that, maybe its rates aren't weighing on growth and on the economy as much as they had previously expected. And I could see a world where that translates into slower rate cuts next year. And then there's the second bucket, which is whatever comes out of the Trump White House. And the Fed is saying at this point that it's just too early to tell. We don't know what tariffs are going to look like. We don't know how trading partners are going to respond. We don't know how corporations are going to respond. And so it's just very difficult for them to sort of factor that into policymaking. But if we do see wide-scale tariffs that economists expect to lift inflation or lift prices in a one-time way, that's clearly going to be something that the Fed has to take on board as it's thinking about what to do next with policy.
Yeah, absolutely. That catching the attention of S&P Global Market Intelligence as well, listing trade troubles as one of their own headwinds that they're going to be watching for next year as well in the global landscape and defining 2025. Gina, thanks so much for taking the time here with us this morning. Appreciate it. Coming up on the morning brief, we'll count you down to the opening bell on Wall Street after U.S. stocks hit new records. Plus, full earnings coverage ahead on Kroger, Dollar General, and more. And we're going to push ahead to results after the bell. Lululemon gearing up in the stretchy pants to report earnings. We'll discuss that and much more on Morning Brief. It's time now for some of today's trending tickers. Let's get to 3 stock movers to watch this morning. First up, we got to talk American Airlines, raising profit expectations ahead of the busy holiday travel season. This follows higher guidance as well from Southwest and JetBlue. Let's take a look at shares of American Air here this morning. You're seeing them move higher by about 7.5%. One of the huge things, of course, that you'll remember even within this is they're now putting this in their adjusted earnings per share in the quarter, expecting it to be between 55 and 75 cents. Compare that to a prior range that they had published of 25 to 50 cents. So Wall Street's certainly baking that into the price action here today. Shares up.
All right, well, let's move over to Dollar General, cutting its annual profit forecast after reporting more than $32 million in hurricane-related expenses for the third quarter. The retail chain also announcing plans to open hundreds of new stores and remodel older ones next year. You can see those shares up just about 0.3%. It is interesting, though, to see that stock move, given that they narrowed their full-year forecast here moving forward on the back of weak customer spending. This has been a long-standing trend for Dollar General. If we can pull up the year-to-date chart, because they have been struggling over the past year. Their peers in this space, the likes of Dollar Tree, also struggling, as we've seen the likes of Walmart being able to take market share as these lower-income consumers have continued to struggle and trade down to other discount retailers.
Let's stay in the retail landscape. Why don't we? Finally, Five Below raising its full-year outlook after topping third-quarter estimates, citing solid Black Friday sales to kick off the holiday season. The discount retailer also naming a new CEO after the previous CEO stepped down back in July. Shares higher on the day by about 13%. New CEO has a name. Winnie Park is the new chief executive officer over at Five Below here. And you'll recognize the name as the chief executive officer of Forever 21 since January of 2022. I know.
Throwback.
Exactly. I don't know. I bought it through.
You still at Forever 21?
I still have a few Forever 21 pieces. Yes.
for you.
Yes. There used to be a store over in Union Square.
Right.
Way back
right.
when.
And now there's one in
Pre-pandemic.
Penn Station. There's a bunch.
Yeah.
There's a bunch. They're all over the place.
Exactly.
Well, shout out Forever 21. All right, we're going to get to another trending ticker that we are watching today. Kroger, the grocery chain's third quarter sales falling short of expectations. The CEO saying the company expects the macro environment to remain uncertain in the near term. Meantime, Kroger's $24 billion acquisition of Albertsons remaining on hold after the FTC sued to block the merger, alleging that it is anti-competitive. Joining us now, we've got a special guest, Jennifer Rhee, over at Bloomberg Intelligence as the senior litigation analyst. Jennifer, it's great to see you again and have you on. You believe the FTC is going to win this case. Talk to us about why.
You know, I really do think so. I attended most of the trial, and I think that the FTC really laid out a great case to show that in numerous, actually over 1,500 markets in the U.S., that the combination of these companies just leaves too few choices for consumers who are grocery shopping. That's the way a deal like this would be looked at, because people obviously shop locally, so you have to look at, many different local markets. And I think even in sort of different market definitions, in some market definitions where they included only really traditional grocery stores, and in other market definitions where they added in super centers and stores like Costco or Sam's Club, I think their economist did a really good job showing that there are markets that would be overly concentrated and that the remedy proposed by the companies just would be insufficient to fix that problem.
What would be that remedy as proposed by the companies? Is it keeping open a certain percentage of the store count of both entities to make sure that they're not just removing some of that optionality from the market?
Yeah, so what they've proposed is to sell almost 600 stores, a mix of Kroger's stores and Albertsons stores, to a company called CNS Wholesale. So really what they have to do is replace the competition that has been lost by virtue of their combination. So create another option for grocery customers in those local regions where the deal ends up being overly concentrated. So normally, something like that sounds like a pretty good remedy. It sounds like it could be sufficient. But the thing about CNS is that it's a very successful wholesale company, but doesn't really have a lot of retail experience. And they'd be taking on almost 600 stores when at this point they operate, I think, only a few dozen stores under the banner Piggly Wiggly, I believe. And they'd be entering regions where they're actually not currently doing business. And the FTC, again, in court, made it sound like a very arduous and complicated process to rebanner the stores and get the private label products that they need, enter supply contracts. That just sounds really tenuous, like it might not work. And I think that they may have convinced the judge that that remedy to that buyer isn't going to be good enough.
Jennifer, I'm curious in the context of kind of the broader market when it comes to regulation. We've seen some bankruptcies come off the back of, the decisions from the federal government and the likes of Spirit, for example. Is that a consideration at all in these decisions, that if a merger doesn't go through, the companies involved might have to close, and therefore, of course, that would have an impact on access to food, for example, in the Kroger case?
It can be a consideration in some cases, but technically the companies have to raise that at trial. They have to put in evidence showing, but for this deal, the seller is likely to be a less viable competitor or may exit the market entirely. There is actually a defense called flailing firm or failing firm that can be used and can sometimes save problematic deals. But in this case, the companies didn't make that argument. And if they didn't make that argument, it's not technically something the judge should be considering when she makes her decision.
As we're kind of evaluating this deal, I almost forgot that Kroger reported earnings today. And as we're thinking about what the company has had to say, talking about the business being more diverse than ever, a model that gives them confidence in their ability to deliver on their guidance right now and generate attractive and sustainable returns for shareholders, I imagine that if this deal does not go through, how much of that capital they might need to reposition towards just investing in some of their customer experience and making sure that shareholders see a broader vision forward, sans a deal here.
Right. And, that's what the antitrust authorities would like to see. Rather than using that capital to buy a competitor, use that capital to reinvest and to improve your quality for consumers and your choice from consumers and basically just compete harder. And so that kind of an outcome would be ideal in terms of the way the antitrust enforcers might be viewing this.
I'll tell you what, Jennifer, you took me back with the Piggly Wiggly mention. Not even back that far, to the summer, actually. Piggly Wiggly, Hilton Head, South Carolina. Shout out. Jennifer, thanks so much. Appreciate it.
Thank you.
Guys, coming up, we're just minutes away from the opening bell on Wall Street. More when Morning Brief returns. There, you're taking a look at some clapping and cheering on your screen at the New York Stock Exchange. Move over those Home Depot orange aprons. We got some blue aprons from Bath & Body Works ringing the opening bell at the NYSE. And, oh yeah, get your tractor pants ready. Tractor Supply Co. ringing the opening bell at the NASDAQ. We kick off today's trading activity with a little bit of green here on the screen as we're taking a look at the S&P 500, just barely in the green, flat, barely to the upside here. The Dow Jones Industrial Average about the same, trying to make up its mind, hyper oscillating, waffling to begin today's trading activity. And the NASDAQ Composite, as that is calibrating. Here you're taking a look as I'll populate this chart for you, just so you can see some of the movement that we've seen, of course, coming off of some new records yesterday as the Dow Jones Industrial Average is now, once again, back up above 45,000, holding on to that level as of right now. We hit that for the first time yesterday, up in aggregate about 19% over the course of this year, up 30% the NASDAQ over the course of this year. And as of right now, you're seeing it up by about 0.1% to start today's trading activity. And the S&P 500, 56th record close yesterday on Wednesday. And now we're taking a look at some slight gains, 0.02%, so flat but barely to the upside to start off today's trading activity. As we always do, let's give you a quick look at some of the sector activity as we're going to begin today's trading session, and then I'll toss it on over to Jared. We're seeing more green than red. Jared, I'll let you take it from here.
All right, thank you. Well, we got energy in the lead here, and real estate looks like it's pulling up the caboose. That's down about 55 basis points. Want to go back to the S&P 500, and Brad, you're absolutely right. 56 record closing highs this year. I'll give you another one. 11 of the past 12 days have been green, and you can see this nice streak in here. This is what we expect going into the end of the year. We could have some hiccups. We got a big jobs report tomorrow. We got an inflation report, CPI, and then we have a Fed meeting. But for the most part, this is the time of year when volatility drops. Now, having said that, we're seeing volatility jump just a little bit today to about 0.03 points right there. And this is coming off some of the lowest levels that we've seen in 4 months. So is this a bottom? Way too early to tell. I'm just kind of searching for any potential headwinds on the horizon. And we even look at the US dollar index. That is going down. That is in favor of equities. Well, I was looking at the sector action for the week so far, and so let's put a 4-day chart on here, a 4-day look at the heat map, and we can see tech. Tech has been leading, that's up 3%. And then you have the two other mega cap sectors. That would be consumer discretionary, which has Amazon and Tesla, and then communication services, which has Alphabet and Meta. So the mega caps, they have been catching up this week. And if I go to the NASDAQ with a 4-day look, you can see this in spades. Amazon and Nvidia, they're almost up to 5% right now, and that's just since the beginning of this week, last Friday close. Meta's up 7%, Tesla another 6%, and you look at Tesla, that has really come back year to date. You can see at the highest levels of the year, still have a little bit to go to get to those record highs that we saw in late 2021, but well on its way. And I also want to take a look at the ARK innovation components, because I think some of the speculative fever that we've seen recently, and we'll take a look at crypto in a second, I promise, we've also seen an ARK innovation fund. This is a 4-day look. I'll give you an intraday look just out of the gate here. Coinbase up 3%. That is a crypto play. And since I'm on that vibe, let's just switch it over to our crypto heat map where Bitcoin is up 7%. And let's just dwell on that for a second. This is a 5-year chart, up 1,277%. But I want to break it down. Let's go to a 2-month chart. And you can see after the election here, we shot up. We've been consolidating. Nice bullish pattern. Didn't even get much of a head fake there. It came down to right at the halfway mark where a lot of day traders were setting their entries. And that is off to the races right now. So 102, 103,000, 104 in sights. But the big picture target is going to be much higher, 150, big round number. Too early to tell. But I also want to point out Ethereum. Ethereum is putting in a really interesting chart. Here's a 5-year. It is just breaking above these 2024 highs. Not quite there just yet, but is breaking above. And then look at that. We got those all-time highs around 4,500 in sights. And then just looking at over the last month, all of the crypto action. Here's an equal weighted so you can see some of these tokens up over 400, 300, 200%. On the top row, the least performing one is up 171.6%. Just to give you one more look at crypto, here's the stocks that we're looking at intraday. Looks like Hut up 9.5%, Riot, blockchain up 8%, and MicroStrategy. That is up 8.67%. And here's a 5-year chart of MicroStrategy, up 2,844%. And it was just lights out, or maybe it's lights on, after breaking out of this range. And I should say that happened before the election. So MicroStrategy, once again, led the way in the crypto rally, guys.
All right, Jared, thanks so much as always. It's time now for our strategy session. Tech stock outperformance gaining momentum with the Magnificent Seven up over 65% year to date and catching a bid this week as well. Joining us with what's next for the rally, we've got Keith Lerner. He is Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, always great to have you. What do we do with this Magnificent Seven rally up 65% year to date? Is the current bid it's catching based on something fundamental, or is it froth heading into year end?
Yeah, well, great to be with you as always, Madison and Brad. So with tech, we're bullish tech. We've been bullish tech all year long, and we are bullish heading into next year. So the way I think about tech is this. If you think about this bull market, the bull market theme, the dominant theme is AI. Every bull market tends to have a theme. And if you believe the bull market is intact, which we do, then that theme is likely to continue to the end of it. And when AI tops, that likely tells you we're at the top of the bull market. And then if I take it just a step back, yes, the Mag 7, as an example, has moved a long way, but earnings momentum in technology and the Magnificent Seven remains to be leadership. And if you overlay relative price trends of technology with relative earning trends, they've been going hand in hand. And maybe the last point is when we look back historically on a 3-year basis, because we got to remember 2022 was a big down year for tech. Tech is up about 38% over the last 3 years. That compares to 250% at the peak of the NASDAQ bubble. So ultimately, all in all, we still think this rally has further to go.
It sounds like Santa's just going to be dropping off shares of NVIDIA to households, shares of Meta platforms. I don't know, Keith, as we look at some of the other attractive areas of the market, it seems like, and Max Kettner brought this up earlier as we were discussing with him of HSBC, it seems like it's a tech and trade. What is your and that you would be adding to this tech trade?
Yeah, so we are staying with tech. We're staying with communication services, and that's where we've been most of this year. The other sector that we like alongside that is financials. That's more the cyclical play. That's more of the economy is going to stay resilient, deregulation, likely a pickup in M&A, and maybe a little bit of a steeper yield curve. So that's another area that we like. And we are still favorable towards large caps. I will say one area, along with that M&A theme and pro-growth policies, we're starting to get more constructive on the mid-cap area as well.
Yeah, Keith, let's go there. What to do with the small caps right now? Is it better to stay focused on mid caps, or is the hype around the incoming administration and the benefits of lower rates, could that flow into small caps as well?
It can. On a relative basis, we prefer actually mid caps. And there's a couple of things. They do trade in tandem somewhat. But when we look at some of the fundamental factors, especially earnings, what you see in this market is the strongest earning trends is at large caps, then mid caps, then small caps. Small cap earnings are actually continuing to move down. And then as we look at, as far as stability over a cycle, mid caps tend to be a bit more stable as well. They also have somewhat less debt relative to small caps. So again, I think they'll trade somewhat together. But if we're looking at the next, say, 6 to 18 months, we would still prefer mid caps because we think they're going to be a little bit of a more steady eddy, even though you might see some real sharp moves in small caps on a shorter term basis.
Keith, as I'm looking out to next year, and I know your team is evaluating what is really going to define and the risk factors that could define the global landscape next year, looking at what S&P Global Market Intelligence is expecting, it seems like economic angst, domestic discontent, elusive alliances, trade troubles are just a few of the things that are on their radar. To what extent do you think that the market is already trying to get ahead of what typically would be many exogenous factors, but I guess with a president or a president-elect that takes to social media more often than those predecessors, some of those become a little more well-known in advance?
Yeah, well, our outlook theme for next year is a bull in a China shop. So think about that for a second. So that means we still think we're in a bull market, but there's going to be this tension of these different forces, some of the ones you mentioned as well. So it's a delicate balance. At times they may get a little bit messy. Some things may get broken a little bit as well. That may provide some opportunities. I think the biggest challenge, those factors you mentioned are out there. I think the biggest challenge, which we're still positive, but if I say, hey, what are some things that you're looking for that could disrupt this market? I think one is just expectations, right? The markets are all about better or worse, not good or bad. Right now, as we see markets make new highs, as we see sentiment surveys start to get elevated, the bar for positive surprises has lifted, right? So I don't think that's an issue in December, but as we get into the first quarter, I think that's going to be the biggest challenge. So if we have some of these these events or these geopolitical events happen, the market is in a less favorable place to absorb that. But again, on a net basis, we still think the economy is resilient, earnings move forward, and the market moves forward. But again, I expect it's going to be somewhat of a bumpier ride next year relative to the smooth ride we've seen over recent months.
Keith Lerner of Truist, thanks so much for joining us here just after the opening bell. Appreciate it.
Thank you.
Maddie, I'll toss it on over to you.
Thanks so much, Brad. Yeah, it is time for our chart of the day. Today, I want to take a look at how we got to that $100,000 milestone for Bitcoin. Let's go back in time for a second here. Back in 2018, Bitcoin futures started trading. You can see very light on volume, obviously, heading into the pandemic. Then we see a huge uptick here, and then Coinbase goes public. That's also a potential catalyst for Bitcoin. Then we've got a lot of volatility. Right in here, you can see that downward trend that is during the collapse of FTX and the slew of legal and financial challenges facing the crypto industry. And then here, right, 2024 spot ETFs start trading for Bitcoin. And then this huge leg up, that's the Trump trade. That is when we started to see Bitcoin catching a bid in anticipation of Trump becoming the next president of the United States. And therefore, we saw a bid in cryptocurrencies and Bitcoin specifically off this idea that there was going to be a more friendly regulatory backdrop for Bitcoin moving forward. Another thing I wanted to point out is that Bitcoin buying begets more buying here. Thanks for pulling up this chart, guys. You can see here at the end where we are now, this uptick of volume for Bitcoin, and volume tends to surge when Bitcoin goes up. So what does that mean? That means that this is likely to have legs, that when we see Bitcoin buying happening, it usually means we get more buying. And I just want to point out, lastly here, the context of the low volume that we had during some of the tensions around Bitcoin in the past here, particularly at the beginning of 2023. We've seen that really coming into context in terms of just a lot more confidence in Bitcoin, again, in anticipation of that regulatory approval and a friendlier backdrop for Bitcoin as we head into a Trump 2.0, Brad.
All right, Maddie, thanks so much for the breakdown there. Appreciate it. Everyone, coming up, we're taking a look at the state of retail after disappointing results from American Eagle sends shares plunging here. We'll see you on the other side of the break.
Shares of American Eagle taking a hit after missing revenue estimates in the latest quarter and issuing weak holiday guidance. Now eyes are turning to earnings from Lululemon coming in later today. Joining us to discuss, we've got Jessica Ramirez, Jane Halley and Associates Senior Research Analyst. Let's start on American Eagle here. Shares are down by the most they've been down in nearly 4 years here. Jessica, what does the path forward look like for American Eagle? Is there a recovery story here?
Look, I think there definitely can be. Now, from yesterday's earnings, obviously guidance was not what investors were expecting. I do think that overall, what we've heard from a lot of earnings is even if the reporting has been decent, the guidance has been quite weak. And again, it hasn't necessarily been a very positive holiday season, what we're hearing. Again, the consumer is, I feel like we've said this all year and I'm only reinforcing it more. The consumer is having a tough time and they are still strapped for cash. So everything that they are buying is with a laser focus mentality. So again, I think that is really what is affecting overall American Eagle, but also there is more competition around apparel and who is doing better. So again, we're starting to see more of the winners really be winners and some of the losers really definitely falling off.
How do, and this promotional cycle specifically, when you've got this much of a rush of consumers that are looking for big deals, looking for deep promotions and discounts here, how much does that also impact the profile for American Eagle going into next year and their planning as well, when they're looking at realization of full price mix versus that discounted mix going into a year where a consumer still is going to perhaps be showing some of the same propensity that we've already seen during this holiday season?
So, it's been actually quite interesting to watch the promotional cadence and then watch prices still be very high. So during the Black Friday weekend, what we noticed when we pulled all the data, and again, we have year-over-year comparisons, so you can also see the messaging. Discounts were slightly higher than last year. Now, last year we had promotions to be down during holiday season. They were pretty low in overall. Now, this year what we saw was there was a small increase across promotions, but when we looked at the prices were still high. So, and with American Eagle specifically, it just really stood out because last year they had, for Black Friday, 30% off site-wide. They had that this year, but then they had hoodies and sweaters starting at $29 this year. Last year, they were starting at $25. So yes, there is still a promotion. However, prices are still high. Now, in terms of the consumer and the retail sector in general, we've had a retail sector that's been running on a much better play. So they're all running on all cylinders, better operations, much more controlled inventory, much more controlled promotions, and then they've had their AURs up. But what we've noticed is because not everyone is going very deep into promotions, others are holding as well. So you'll only see very deep promotions if everyone goes into deep promotions. And I think because we've had such great margins despite the sales growth, retailers want to keep that up. And I think it's to a healthy perspective in that sense. Now, as a consumer is out shopping, what they're looking for, value goes in two ways. Is a product priced right, or is a promotion good enough? And that could mean that they will be shopping for something that they might hold value to in terms of quality and something that they may need for now. Is it more expensive and will it last me longer? Okay, I'll put my money into that. And I might take the promotion somewhere else, or I might spend less in another category.
Jessica, I want to look ahead to those Lulu earnings coming up today. What is the thing that you are going to be watching?
Yeah, so for Lulu, what we're mostly watching is how are they performing in the US? Now, they had a slowdown in the previous quarter, and we do feel that might continue. They had talked about newness. Now, when we've done our store checks, we have seen some newness. We've seen product that's been more so leaning towards wear to work, and they've been quite more design oriented in that sense. We've seen more tracksuits, which they were supposed to bring in to the quarter, but they did not expect more newness until the next year. So again, I've seen some come in, but not enough. There still needs newness, and there is much more competitive around Lulu. And I think everyone has talked about Aloe and Biore, but there's also competition from upstart brands like On and Hoka and even New Balance that they've started tapping into apparel. And even their apparel assortment is quite small at the moment it is starting to resonate with some consumers. So again, just quite cautious on their competition as well.
Yeah, you mentioned the U.S., but to what extent do you think, and you get a sense based on what this company's talked about before in their international expansion, that they're going to be prioritizing regions like China and leading into culture there, yoga community there, and to what extent are analysts and investors really anticipating this to be a core driver of growth for the business?
So we've actually we've seen China as they've done well and they continue to resonate with the consumer there. They do a lot of localization and we like their strategy in China. But I feel like investors are still looking at the US market is the largest part for them. And that is where the slowdown has occurred. So I think that is still a priority for investors overall. And again, today we'll see what guidance looks like. I feel, again, when consumers are shopping more where to work, leggings might take a step down, but I had also seen from our proprietary data, we've seen leggings take a slowdown as well, because if we think of the sports that consumers are interested in, you're not wearing leggings to the golf course, you're not wearing leggings for racket sports, you're not wearing leggings for basketball. So again, it's a different outfit. And in their last call, they did talk about not having enough shorts. So shorts you will use for racket sports and you will use them for running. Obviously, now that we're going into the colder, finally, it'll be a little bit of a change. But again, leggings doesn't necessarily take front row and center at the moment, even though we're very sports specific as a consumer today.
You're spot on. My friends do look at me a little weird when I wear my leggings to play golf, so I've started to go in a different direction. Jessica, thanks so much for taking the time here today. Appreciate it.
Thank you.
All your markets action ahead. Stay tuned. You're watching Morning Brief.
couple of years. But weaker demand in the first half of 2025 could lead to a correction. The analysts' more bearish views here are rare on the street. The stock has 29 buys, 14 holds, and only 2 sells.
And finally here, let's talk a little HPE, Hewlett-Packard Enterprise, getting an upgrade at Morgan Stanley to overweight from equal weight. Now the price target, that was also pushed to $28 from $23. The call comes ahead of fourth quarter results. Those are out after the bell. And analyst Meta Marshall citing positive trends in enterprise spending and says the pending acquisition of networking firm Juniper is a catalyst for re-rating the stock, given opportunity for earnings upside here. Shares are up 2%.
There you go. Well, that's going to do it for the morning brief. Join me and my co-host Josh Schaefer in the next hour for more analysis right here on Catalysts. Welcome to Catalyst. I'm Madison Mills alongside Josh Schaefer. Today, we are 30 minutes into the U.S. trading day. Let's get to the three catalysts we're watching this hour.
First up, we break down what Trump's pick for the SEC means for the future of digital assets after Bitcoin tops $100,000.
And Elon Musk heading to Capitol Hill with an ambitious goal of slashing $2 trillion in government spending. Is it possible? We'll discuss.
And U.S. stocks hitting new record highs amid the unwavering rally. What will the November payrolls report mean for the markets? We'll discuss.
Bitcoin finally crossing that $100,000 mark yesterday during trade. But if you take a look at some of these alternative digital assets, they're actually outperforming Bitcoin over the past 10 days. Here with more, we've got Andy Baer, CoinDesk Indices Head of Product. Andy, great to speak with you. We finally got over 100K here, but let's talk about the assets outside of Bitcoin. Where should investors be keeping an eye for other opportunities?
That's right. 9:33 last night, by our reckoning, we had that champagne moment where we crossed 100,000 and got to the CoinDesk Bitcoin Price Index got to 103 and change about half an hour later. Bitcoin's regulatory status is pretty much done for the most part, right? Futures contracts, ETFs, spot available in 50 states. I think the mention by Chairman Powell yesterday and the integration of digital assets into the messaging around future Chair Atkins' position kind of helps the adoption momentum. But Bitcoin kind of doesn't need a lot more of that. We were talking earlier that the trades happen overnight. There's plenty of trade momentum there. So Bitcoin's great as a store of value, as a digital gold. I think we're done. The other assets which count more on regulatory pavement that think about things like smart contracts, stable coins, future of finance, Web3, things that'll change our lives in the future. They need the regulatory pavement. Since the day before Election Day, the CoinDesk 20 index, which caps Bitcoin and Ether weights but looks at altcoins mostly, has doubled. So that momentum has really been based on the news and on the future of what's happening in the new administration.
So, Andy, I'm curious about these other coins. I want to stick on that for a second. I'm looking at our Wi-Fi Interactive right now. You can see Bitcoin is up about 50% over the last month. Right there. Most of the coins, though, outperforming, as you were just pointing out, right? Like I'll pull up Ripple, up over 350%. What do investors need to know about some of these other coins when it comes to maybe a Ripple or Cardano? What coins stick out in that altcoin space?
Yeah, it's a great question because for most investors, for what we call the 5%ers, most of people who are really going to allocate 5%, they can't. They can't do it, right? They don't want to pick which and they don't want to pick when. We know what Ripple does, and we know about the lawsuit history with the SEC, and it's win after win after win. But you really have to be in the weeds to track that, and timing is almost impossible, right? So people should understand what a smart contract platform layer one is. They should understand what Ethereum does, and the things that are built on top of Ethereum. Smart contracts, stable coins, NFTs, meme coins, they have to reside somewhere. Think of Ethereum as a clearing layer of that. Solana, Cardano are competitors to that. Right, so already we've probably lost a bunch of people who have said, great, just give me an index, give me a QQQ of crypto and let me buy that. That's the thing that's really sprung to life when the regulatory pavement looked like it was going to get set in place next year.
Is the QQQ of Bitcoin the right way to get in for people who are not in yet?
In the United States, it's hard because, and we're hoping that it gets easier next year, there are funds in place, there are private funds in place which allow access to this. And the great thing about that CoinDesk 20 index, Bitcoin and Ether are capped very low, so you get a lot of exposure to the altcoins. If you have some Bitcoin already, CoinDesk 20 makes that kind of perfect next allocation into the future of finance. So that's really proven itself. It's outperformed Bitcoin in the past week, in the past month, and in the past year, simply because timing's hard to get right. But when the news starts to get good, there's a lot of built-up energy in future of finance.
I want to talk about the SEC chair nomination, Paul Atkins, right? We know that he is expected to at least not be as much of a crypto hawk per se as Gary Gensler, and he's relatively pro-crypto. But what can he actually do that's going to help the cryptocurrency?
It's a great question. Go to Hong Kong, go to Dubai, go to Europe. You have dedicated digital asset regulators. We don't have that here. We have, you have two outfielders, the CFTC and the SEC. There's a ball in the air, and they're just deciding who's going to catch it, right? And that hasn't worked, right? So there have been some news reports that cryptocurrency regulation might be housed inside the CFTC, and the SEC would have less to say about it. However that works out, it's fine, but you need dedicated, reliable cryptocurrency regulation so that new projects and existing projects know what they can do and what they can't do. I think we've demonstrated pretty convincingly that trying to decide whether they're commodities or securities is something which is only going to hold back the United States. So the administration has to get together and actually build stuff. The biggest myth in the world is that crypto wants no regulation. We want a lot of regulation, but that's written clearly.
So what does a crypto czar position getting added to the outfield do to that dynamic?
It's determined regulation over blockchain assets, which can understand their unique nature, which can understand how they grow. They're kind of dual nature as being able to be traded in native form on exchanges like Coinbase or Kraken, but also be wrapped into traditional investment products like futures and ETFs. We need all of that. Getting rid of any of that is kind of a waste of what has been built up over the last 16 years. So dedicated regulation about digital assets, and hopefully not this one by one, ETF's okay on this, but not okay on those 5. We need a way to sort of wholesale. As an index company, we're hoping that indexing provides regulators a way to look at diversification as a way to protect investors while still giving them access to more of the digital asset class.
Andy, thanks so much for coming in studio. We appreciate it.
Thank you.
Well, mega cap tech stocks are priced to perfection at 34 times earnings, but that also means they're vulnerable to any disappointment, according to our next guest. Joining us now, we've got Nancy Curtin, Alti Tiedemann Global's Chief Investment Officer, who oversees $77 billion in assets under management. Nancy, thanks for being here. Mag 7 stocks, they're headed for their second annual gains and obviously have seen a huge rally up over 65% year to date. Is the party just going to continue?
Well, first of all, let's just take a look at what's happened in the last 5 months. So although they're up 65% year to date, in the last 5 months, the best sectors have not been tech, right? It's been financials and utilities, industrial, consumer discretionary, and maybe real estate on the back of the Trump win. I don't know how that one got in there. But at the end of the day, we are seeing a broadening in market participation. That's been one of our views this year, and we're beginning to see this take hold, which I think is quite pleasing. That doesn't mean that tech still doesn't have a place in portfolios. As we look forward to 2025, we expect tech earnings to decelerate from something around the 40% mark to around 20%. They'll need to deliver given those lofty valuations that you mentioned right up front.
Nancy, part of the trend with big tech, though, that's been driving this rally has been they're outperforming those earnings estimates, right? We've seen consistent revisions up over the past year and a half now. Is that a case that you're considering where we could still see tech outperform if, yes, 40 drops to 20, but then they actually outperform that 20 and it goes to 25 or 30, right? And it's better than expected.
I think they're really good at outperforming expectations. That's just what they do, and they're going to continue to do that. So you're right, and that will provide some support. But I think it's going to be a different market in 2025. Potentially, we've got tax cuts, we've got deregulation, we've got a lot of things happening that can support wider bits of the market. So what I'm saying is, yeah, tech, you still want to be there. If it doesn't deliver, it's vulnerable to disappointment, but other parts of the market also likely to participate, and particularly, I think, participate from some of the things that President-elect Trump looks to be putting in place. Again, deregulation, tax cuts, this is good for the other parts, the more domestic parts of the economy, the more cyclical parts of the economy, which have been rallying quite nicely over the last 5 months.
How are you thinking about the incoming administration's export controls moving forward and any changes that Trump might make to the Chips and Sciences Act?
You never know with Trump. There's a sort of good news, bad news. I mean, on the good news side, and you heard the prior speaker bringing in Paul Atkins in terms of Bitcoin, sort of super interesting. He's pro cryptocurrencies. And remember, Donald Trump wants to have the US dollar to be a reserve currency. We have the French government falling because they can't fund their deficit. The United States runs a comparable deficit. No problem here. So Bitcoin, being the superpower of the world, is one way that we can continue to control currencies, not just the US dollar, but digital currencies as well. So that's kind of a positive. On the export side, again, Trump imposing export controls. We're in a bit of a tit for tat with China right now. So they've come back and said, well, you can't have our critical minerals. Is that a problem? Lower down in the electronics PC area, in the industrial military complex, it could be a problem. So we're in a bit of a tit for tat at the moment, but that's all part and parcel of Trump getting what he wants, which is better access to the Chinese market, better terms of trade, et cetera. So I think that's a tricky one at the moment. And the third one that you mentioned is the Chips and Science Act. He absolutely hates that, right? And you do have to scratch your head We have spent about $280 billion so far. We do have TSMC and Samsung that are going to build fab facilities in the United States. That's a good thing. But you know that $7.9 billion we gave to Intel last week? Isn't that the same company that removed 15,000 workers, lost $17 billion in a quarter, and just ousted their CEO? Is that the kind of company you give $7.9 billion of taxpayer money to? So I think he's going to make some changes here. Very hard to underline legislative programs, but expect some kind of truncation, so to speak, of both the CHIPS Act and also Inflation Reduction Act as well.
Nancy, you mentioned something there that caught my attention. You said in some ways we never really know with Trump, right, where exactly things are going to fall. I'm curious, headed into 2025, is he going to be one of the key drivers of market volatility? Like, is what Trump says going to be perhaps more important than us debating what the Fed may or may not do from meeting to meeting? Is it going to be a Trump-driven market, or some of the other macro factors going to perhaps come up above over Trump?
I mean, lots of shorter-term traders will absolutely be trying to play every sentence and every move that he makes. Our view is we are longer-term investors. We got to stick with the fundamentals, which, by the way, are pretty positive. And deregulation and tax cuts add to positive fundamentals. So we're pretty optimistic about the outlook for 2025. We've been overweight equities really since 2023. So we're going to continue to ride this bull market. Remember, if you get through 2 years of a bull market, 70% of the time you get through 3 years. We think the fundamentals look pretty good. Earnings look pretty good. And by the way, a little animal spirits, M&A, IPOs would also, I think, enhance the trajectory. So let's focus on the fundamentals. But you're right, there will be traders that will try to play every sentence, every move. And I think that's kind of a loser's game because he can change his mind. In concept, he'll do what he said he would do, but the actual implementation remains to be seen. Very hard to play that.
Nancy, going long term here, one of the big topics that comes up on our Yahoo Finance NVIDIA ticker page is putting a big chunk of your 401k into NVIDIA. Is that a strategy that you think is a good one? Does the conviction in NVIDIA have legs in the next, say, 30, 40 years?
I mean, NVIDIA is a stock that's $3.5 trillion, give or take. It's the second largest stock, sort of neck and neck with Apple. Is it really going to triple from here? I think you have to ask yourself. Look, our view is the Mag 7, and this year it's been the four horsemen. It hasn't even been the Mag 7 in terms of what's rallied. If you're passively exposed to the United States, it means that you're not underweight NVIDIA, which is a good thing because a lot of active managers have been and missed that ride. But let's just step back and look at the fundamentals. I mean, NVIDIA, fantastic, right? At the moment, demand is definitely exceeding supply, but there's competition. 40% of its customers are frenemies. They're also trying to make chips as well. They may or may not be as successful. They may or may not be able to compete. You've got AMD. I'm not so sure about Intel, as I mentioned, but there's competition that could eat away at margins in the future. But near term, in the next quarter, kind of hard to see anything eroding the very significant market share that NVIDIA has, particularly given the demand for Blackwell that's coming.
Nancy, always a lot to break down when it comes to NVIDIA, but we're going to have to leave it there. Nancy Curtin of Alti Team and Global, appreciate you joining us today.
Yeah, love to be here. Super. Thanks, guys.
All right, coming up, we're looking at today's trending tickers. We'll give you the news behind the moves next on Catalyst.
It's time now for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, MicroStrategy becoming a hot bet with hedge funds buying billions in convertible notes sold by the company to fund its Bitcoin buying. Since the end of October, MicroStrategy has bought more than $13 billion in Bitcoin and issued $3 billion in zero-interest convertible notes. Now, Josh, as you know, some folks have come out and said that that is a short story for MicroStrategy. If you're issuing debt to be able to buy an asset like Bitcoin, maybe that's a story that won't end well for MicroStrategy. But if you take a look at the stock year to date, it's clearly done well for them so far. It's up nearly 500%. Over that, actually, 560% year to date. So it's certainly working for now.
To me, Maddie, when we start talking about hedge funds placing perhaps arbitrage bets, using convertible debt, you start to get into all of these wonky things. And it just reminds me of we're constantly looking at the stock and trying to figure out why it's moving. Maybe it's just a little bit too confusing if you're a retail investor, to be quite frank, right? I think part of what's going on with MicroStrategy is it's not really just a stock that's trading as Bitcoin moves. There's a lot more happening here. And that's really the takeaway from this story to me is for a while it was, well, MicroStrategy owns a lot of Bitcoin. Michael Saylor keeps buying Bitcoin. So if Bitcoin goes up, then MicroStrategy will go up. That's not exactly what's happening with this stock. There's a lot more going on that's moving it. So if you're an investor that's looking to get into a stock and equity that you can buy that is related to Bitcoin, it's starting to feel like MicroStrategy is, yes, it's related to Bitcoin, but perhaps maybe leveraged to Bitcoin in some ways, right? It's like a 3x leverage trade, and it's not exactly what you buy if you're interested in just buying a stock that might be similar to Bitcoin, especially now with the ETFs.
It's the complete opposite end of the spectrum of what Andy was telling us earlier, which is that the retail investor trade might be whatever the QQQ of Bitcoin is. MicroStrategy feels like it's the complete opposite end of the spectrum from that.
Yeah, it'll be interesting to see how the stock keeps moving now. As you said, up over 500% this year.
560%.
560% this year. So it's something we'll certainly keep looking at.
And something we will be speaking about with MicroStrategy's executive chairman, Michael Saylor. He will join Yahoo Finance Live later this afternoon. Tune into Market Domination at 3 p.m. Eastern to catch that conversation here.
Next up, we're taking a look at Meta, planning to build a $10 billion AI data center in Louisiana. The facility is expected to be 4 million square feet, making it the company's largest data center ever. Construction is expected to begin this month and continue through 2030. Maddie, I think what stands out to me here is construction's beginning this month, right? We're in the last month of 2024, continuing through 2030. We're having these conversations, and I know you've been having these conversations as well with companies like Amazon about how long this AI build-out will take, and that perhaps the end of the AI build-out really just isn't in sight. And I think this is a reminder of that to us. They're building out this massive data center and saying 6 years down the line, it's going to be done. That's a good idea. It gives you a good idea of how long we're going to be talking about just these build-outs, and that it really does feel like, as our friend Dan Ives always says, early innings, right? If it's 2024 and this thing isn't going to be done to 2030, that's pretty early innings as far as the overall development.
It is, and it's interesting given that it's not just about the data centers themselves, it's also about the energy needed to power those data centers. We know that this week Meta announced that it's going to issue a formal request for proposals from developers who could give it the energy required. Specifically, they're looking into nuclear for these data centers because they require a heck of a lot of energy. They're looking to add 1 to 4 gigawatts of power for these data centers, and Torsten Slok has done a great job pointing this out. The need for power moving forward off the back of the AI boom is going to be a really critical part of the energy infrastructure that needs to be invested in, not just the physical data centers, but also how are we powering them.
Right, and when you see a company spending this much and building these data centers, it adds up to why a lot of people are talking about, as you're getting at, Maddie, perhaps the utility sector in 2025, or what companies are going to be powering this massive data center that Meta is building. Yeah. How do they get that power? That seems to be kind of the next question in this AI build. Okay, we know Meta and other hyperscalers are spending. Who are they going to pay to help them power that? Seems to be, to me, the looming AI question at this point that we don't quite know the answer to.
A lot of questions left with AI, but we're going to get to a tried and true stock here. Disney raising its dividend by 33% to $1 a share. This after the company reported strong earnings last month, boosted by its streaming profit. You can see those shares down about 0.5% in the trade today. The dividend will be paid to shareholders in 2 50-cent installments in January and July of next year. This is a fascinating decision. I want to point to CEO Bob Iger's statement from this morning saying, with the company operating from a renewed position of strength, "We are pleased to increase the dividend for shareholders while continuing to invest." They're bullish on that strength story, which is interesting given that they just had to suspend their dividend back in 2020 in advance of concerns about park sales going down during the pandemic. Now all of a sudden streaming's up, it's a party over at Disney.
Yeah, you raise your dividend, it just sends a little bit of a sign of confidence, right? Okay, we're feeling pretty good about this story. They're also investing in things, right? We know that new cruise ship that was just here in New York riding around, right? They're investing in the company as well and putting back in that. And also I think, Maddie, when you raise a dividend, you're trying to keep investors in for the long run to some extent, right? That's the point of a dividend, would be rewarding long-term shareholders on a consistent basis. And what stuck out to me, I was reading a note from Jefferies. They just started coverage on Disney, initiating at a hold. And one thing that sticks out to me is they like the D2C opportunity on the streaming side, but they're pointing out that they don't think margins move from 1% to 10% until 2027. Essentially saying they like the story, but it might take a little while to get there. And when you think about a dividend, it's something that you want investors to stay with you for the ride. So maybe the rest of this Disney ride back up, we're looking at that chart, it's certainly come way back up, but maybe the rest of that ride is going to take a little bit longer.
And maybe that's why when you take a look at analyst recommendations, we got about 70% of the street with a buy rating, 30% with a hold, and just one lonely sell here. So perhaps that group of cohorts in the hold space, just waiting to see a little bit more of a long-term growth story and hear more from Disney on that moving forward. All right, well, coming up, we're going to take a closer look at President-elect Trump's economic agenda with his former economic senior advisor, Stephen Moore. That's coming up next right here on Catalysts. Vivek Ramaswamy and Elon Musk meeting with Republican leaders today to discuss their plans to slash the U.S. government's debt. Today's meeting is the latest indication that officials are taking Trump's efficiency push seriously. Joining us now to discuss, we've got Gautam Mukunda, lecturer at the Yale School of Management. Gautam, thanks for being here. I know you've been critical of Musk in the past, but pointing to what he did at X, he came in and fired 80% of the staff. If he does a similar thing with the government, will he make a dent in the deficit?
Well, if he fired 80% of the staff of the government, he would make a dent in the deficit, but probably not in the direction he wants. So I just want to note, right, I have been critical of Musk and also praised Musk. I think I've often said that SpaceX is the most impressive company in the world without qualifications or reservations. So that's not it is a much more sort of complex view than that. But something like the Department of Government Efficiency, a sort of massive government reform effort, is desperately needed, right? It is something that is long overdue. There's an endless number of lists of things where the government performance is just not where it should be. It is actually true that the Pentagon, for example, has never, not once, ever passed an audit. But the approach that they're talking about taking is sort of so profoundly mismatched to the needs of what the government actually has that it's hard to see how this effort is going to be helpful. Let me just give you a really simple example. All of their focus has been on who can we fire, who can we cut, what can we get rid of. Okay, if we take a look at the IRS, we have a lot of studies that show that every additional marginal dollar that's sort of every dollar you add to the IRS's enforcement budget that targets high earners generates a minimum of 40 additional dollars in revenue. So that would be a major government reform, right? Getting the IRS the ability to target the more than $600 billion in tax evasion, disproportionately with the highest earning Americans, and giving it the resources to go after those people and actually collect the taxes that are owed. But that is exactly the opposite of the approach that they seem to be talking about and taking.
So, Gautam, I'm curious, we still don't quite know, I guess, exactly what's going to play out here, right? It's like a lot of the other political things we're talking about right now in 2025. It's a little bit remain to be seen. Do you think there's a chance that they shift direction at all based on how public perception comes out as they start some of these policies? It seems like, at least to me, you would maybe want to get an easy thing through the door and get it approved so you can sort of stay on staff, right? We know President-elect Trump doesn't really let people hang around too long if they're not being successful.
I mean, they're talking about getting rid of daylight savings time, and if they do that, I'm all in favor of it. Like, that's a great initiative, long overdue. So what I say is, Elon Musk is sort of one of the most extraordinary business people who've ever lived. Like, you can argue about whether early Elon and current Elon are very different people, as they seem to be, and all that is true. But he has a track record of doing things that are huge, and he certainly has a track record of adjusting. Vivek Ramaswamy is a very different type of character, and so it gives me sort of a lot less confidence. But in both cases, what I say is the track record and the tagging to the wins is also going to be biased just by the fact that political pressures are going to revolve around the fact that these people don't have authority, right? So that there's no statutory authority attached to the Department of Governmental Efficiency. It's not even clear what they will be, right? If they're a commission, then legally they have to be balanced between both parties and have space for dissenting views. Does that sound like what's being put together? So the most likely case here is this becomes a report that nobody reads, but the risk factor is much more than that. I'd focus in on things. So, for example, in the last few weeks, the Trump campaign has sort of tied itself to Robert F. Kennedy quite closely, and they want to make America healthy again. There's a lot of focus on taking toxic chemicals out of food. So, all of that seems like a great idea. Like, it would be really good to get American food to the same levels of health standards that you see in Western Europe and other developed countries. That would be fantastic. But that takes large numbers of highly skilled scientists and administrators to do the test to figure out what we need to remove and then to do the regulations that get these things out of the food supply. The same people who are saying they want to destroy the administrative state say they want to regulate our food supply to make it more safe. You can do one or the other, but you can't do both. Those are just profoundly incompatible goals, and they're going to kind of have to pick which one of those they want to pursue.
That's interesting in the context, though, of something like the Supreme Court overturning Chevron earlier this year. Do you think that kind of move from the judicial side of the government is going to potentially lead to more leeway for the likes of RFK Jr. to come in and kind of do whatever he wants?
So I think the end of Chevron deference was actually, it's been profoundly misunderstood, and it's going to have a lot of complications that we haven't thought through yet. But what ending Chevron did essentially was transfer power from the executive branch to the judicial branch. So there's a huge shift there where judges are going to be making decisions that, frankly, almost, very, very few, if any, judges actually have the technical background to do. But there are plenty of judges who were appointed by Democratic presidents. And so what we're actually going to see, I think, is a level of litigation and conflicting court decisions that would take even a normally speedy judiciary, and the judiciary has not been operating quickly under the Roberts Court, years or even decades to sort out. So what you'll see is different courts and different circuits arrogating to themselves authority that has traditionally gone to the executive branch. It's, I think, actually more likely to make it harder for President Trump to do what he wants to do than easier.
Well, I want to go back to the AI of it all here. There's this bullishness around the idea of AI being useful and technology being useful to create more efficiencies. Our executive editor, Brian Sozzi, asked Salesforce's Mark Benioff about DOGE, Department of Government Efficiency, and whether tech could help push the government to be more efficient. Here's what he had to say.
Absolutely. And I think you'll see that an agent-first government is a government that's going to be more efficient and more well-run, using more technology. We already have relationships with a lot of government agencies. We're already talking to them about how to bring this technology in to create more efficient agencies.
Do you buy that argument that the tech focus of Musk and Ramaswamy could be a benefit to the problem of the deficit?
I buy the argument that the government desperately needs a better tech strategy and a better ability to use tech. And Mark Benioff is entirely right in saying that it could be vastly more efficient. I'm pretty skeptical that, Ramaswamy definitely not, and that Musk could do that for the government, just because the government is different than a business, right? We don't actually want the government to run a business. It is not the government's to run like a business. It's not the government's goal to run at a profit. The government does things that in many cases are too important for us to rely on business, and in other cases are too much what we call public goods. There are things that you can't make it a profit from, but that have to be done. So, for example, the U.S. government manages the extraordinary risk of the nuclear waste that was produced by decades of Department of Defense nuclear weapons programs. The Hanford nuclear plant, for example, it's kind of hard to believe when you hear about this, but there are rivers of underground nuclear waste that are moving through parts of the country that have to be managed by the U.S. government. That takes people with extraordinary levels of science and engineering talent. Can a technology strategy help you with that? Absolutely. Only high technology can help you with that problem. But saying, well, an agent-based thing can sort of solve these problems or get us out of the incredibly difficult regulatory trade-offs you need to make, that's just not true. And businesses don't deal with that kind of problem. We create governments to deal with that kind of problem precisely because businesses cannot.
Gautam, a lot to break down when it comes to Doge, and I'm sure we're going to keep talking about it. We look forward to having you back again soon to keep this conversation
Thanks.
going.
Always a pleasure.
Coming up, we'll bring you the latest updates on Trump's economic team and what it means for the economy overall and your portfolio next.
President-elect Trump's economic team is taking shape, but policy positions from nominees are varied. On one side, day one tariff advocates. Trump's senior trade advisor pick, Peter Navarro, is a notable China hawk who has indicated tariffs will be at the top of Trump's to-do list. Meantime, others, like Treasury Secretary nominee Scott Bessent, he sees tariffs as a negotiating tactic. So what do the conflicting messages from top aides mean for Trump's final move? Here to discuss, we've got Stephen Moore. He is an economic advisor to Trump. Steve, it's great to have you on here. Let's start with the divergence on tariffs. As I just mentioned, Treasury Secretary Scott Bessent, he's going to be in the Oval Office talking about them as a negotiating tactic. Then you're going to have Navarro come in and say we need an iron wall. Who wins?
That's a great question. Look, Donald Trump is going to win. He's going to determine what he wants to do. There's no question that tariffs will be part of his economic strategy, both as a negotiating tool and as a potential way to raise revenues. One of the things that he said throughout the campaign, something I tend to agree with, and I'm a free trade guy. I understand tariffs are taxes. Tariffs can be very dangerous. But what Trump is talking about is increasing tariffs on things that are made in, say, China or Europe, and reducing income taxes on things that are made here in the United States. And, you know, if it's something made in Pennsylvania or Ohio or Michigan, why not give a tax advantage to that rather than things that are coming in from countries like China? So I believe that's the whole strategy here. And I think that we will see, I think we'll see some new tariffs, no question about it. But I think it's going to be a strategy that will work for American workers.
You mentioned taxes. Part of your role during Trump's first round in the White House involved drafting those tax plans. So far, it seems like the day one focus is going to be tariffs. We haven't heard much from Trump on taxes. Senator Thune has been talking about the day one focus being immigration. When can we expect the tax cut legislation to come?
It's one of the very top priorities. It's something I've been working with Trump on. You know, we helped write the bill in 2017, which we're all very proud of. It was a huge success for the American economy. I want to make sure that your viewers understand that doing nothing is not an option, because if we don't pass a tax bill this year, then you were going to have a situation where you're going to have those tax cuts expire, and we cannot allow that to happen. We have to have a tax bill. There will be a tax bill, and I think it will extend the Trump tax cuts, may use some tariffs to pay for that. And then I think there's some talk about other types of things that Trump talked about during the campaign, like not taxing tips and like not taxing Social Security benefits. So it'll be a large package. It'll have to go through what's called reconciliation process, which means that you have a fixed amount of money that you can put in this box, and you can pass that bill with only 51 votes in the Senate. It's one of the few times you only require 51 rather than 60 votes. So, but I believe it'll be done in the first, I'll say in the first 180 days.
Okay, very good outlook there, Steve. Before you go, I want to ask you about the kind of double whammy potential impact of tariffs on inflation and potential immigration policies on inflation. Do you think Trump gets the risk to inflation ticking back up associated with those policies?
Well, one thing that's been misunderstood about the tariff issue is, yes, if you were just to raise tariffs, that would certainly raise prices to consumers, because tariffs are just a consumer tax when you buy something from, say, China or Mexico. But I think what a lot of people are missing, like Larry Summers, is what Trump isn't talking about just raising tariffs. He's also talking about reducing other taxes. So that's why a lot of these economists, I think, have it wrong. If you raise tariffs but lower income taxes, that's going to be good for the economy, potentially not bad.
All right, Steve, we got to leave it there. Thanks so much for your time this morning.
Bye.
Elon Musk and Vivek Ramaswamy head to Capitol Hill today to outline their vision for cutting trillions from the U.S. government. Rochelle Akufo joins us now from Washington, D.C. Rochelle, what's the latest?
Hi, guys. So, yes, of course, Mike Johnson, the House Speaker here, invited Vivek Ramaswamy and Elon Musk to really lay out their plan for some of the cost cutting that they want to see in the federal budget. And keep in mind, they also want to reduce up to 75% in the federal workforce and a $2 trillion cut in federal spending. There's also been talk in their recent op-eds and also through their Twitter account on Doge as well, saying that they would like to eliminate entire departments as well. Of course, they've mentioned the FBI, they've mentioned the Consumer Financial Protection Bureau, which actually came about as a result of the 2008 financial crisis. Now, it's interesting because, there's a lot of talk between how much this advisory body can have versus the actual impact it can have. Because some of these things are very sweeping, but when you look at how the budget actually breaks down, mandatory spending, which makes up the bulk of it, 3/4 of the federal budget, those are your entitlement programs, your Social Security, your Medicaid. So these are the things that obviously people are very unlikely to want to see cut. And we might see some wrangling among even the GOP, being that House Speaker Mike Johnson has a very slim majority there. Also want to talk about this idea of balancing the budget. We've been seeing them continuously talk about, when was the last time we ran, a budget surplus? That was in 2001 under President Clinton. So everyone agrees that it is a bipartisan issue, that there are cuts that need to be made. The question is, where are you going to make them? For example, California Representative Ro Khanna, he said, yes, there are cuts that could be made, but he's more focused on the bloated defense budget than some of these other entitlement cuts. So it'll be interesting to see some of the wrangling, but we are seeing at least some bipartisan interest in getting the budget and the deficit under control. But it's just a case of very unlikely to see entire departments getting wiped out. That is still going to need some wrangling within Congress, guys.
All right, Rochelle, thanks so much for bringing us your reporting today. We appreciate it. Coming up here tomorrow is Jobs Day. We're going to dive into the market's expectations and potential impact on the Fed next, right here on Catalyst.
Investors awaiting the November jobs report out at 8:30 a.m. Eastern on Friday. Here with the latest expectations and what it could mean for the Fed's next decision is our very own Jennifer Schonberger. Jennifer, what are we looking for on Friday?
Good morning, Josh. Great to see you. The job market expected to bounce back in November after getting slammed by 2 hurricanes and a worker strike at Boeing in October. The reversal expected to boost payrolls by 215,000 from the paltry 12,000 seen in October, excluding revisions. The unemployment rate expected to hold steady at 4.1%. Manufacturing jobs expected to rebound by 30,000 from a negative 46,000 in October. Meanwhile, the beige book for November released on Wednesday indicated that hiring activity was subdued, but that the level of layoffs was also low. Looking ahead, businesses expect employment to remain steady or rise slightly over the next year, but many were cautious in their optimism about any pickup in hiring. So what does all of this mean for the Federal Reserve's next interest rate move? Well, if the jobs report comes in as expected, it's unlikely to move the needle. While we heard from Fed Chair Jay Powell on Wednesday, he didn't suggest what the Fed might do later this month, but he did say that because the economy is stronger than the Fed thought earlier in the fall, quote, we can afford to be a little more cautious. Elsewhere, Fed Governor Chris Waller said he's leaning towards another rate cut for the next policy meeting, noting that the labor market appears to finally be in balance and the Fed should, quote, aim to keep it that way, but said that if the next inflation data continue to show a slowdown in moderation, then he could lean towards holding rates steady. We will get another reading on inflation next week when the consumer price index is due out on Wednesday, followed by producer prices on Thursday. Markets pricing in about a 70% chance that the Fed will cut rates by another 1/4 percentage point at its policy meeting later this month. Next year, the pace of rate cuts expected to drop off. Back to you.
Jennifer, thank you so much as always. We appreciate it. So how can we expect markets to react to tomorrow's jobs data? For more on that, we've got John Kadunas. He is the president and CEO of Calamos Investments. It's great to have you in studio with us. What is your expectation heading into the jobs print?
I don't think the markets are going to do much because of the job numbers. I think they're going to come in line, as was said earlier. They're going to be higher because of the bad month last month. But that's not really driving the markets these days. A lot of it is more event-driven. What we're hearing about the next administration coming in and stuff. And so I don't see that job market data going to be a big influence in the market.
Is there a risk on your radar in December right now, right? Because we have the jobs report Friday, you have inflation next week, and you have one more Fed meeting. But it seems to me like markets are just sort of drifting higher into year end, and it's hard to really circle where that risk is. Is there something you're watching?
Well, the inflation numbers definitely are something, if they're really out of whack, I think that's going to be something that people are going to look at, right? And then the Fed's going to decide, what to do, if they're going to do another 25 or not. It's kind of up in the air right now. They need a little bit more data. Either way, it's not going to move the needle. The markets are trading up. The Trump trade is on. We're seeing that. We saw it. Look, nobody knew who was going to win the election, but the fact that people thought that Trump might win the election, we've seen the Trump trade for the last 6 months.
If inflation is sticky, though, right, and the Fed doesn't cut in all of 2025, right? That's a theory that's out there at this point, that maybe they cut in December and they just stay there. Is that a risk to equities if that also means perhaps the 10 years rising, right, and rates go up? Or how do you evaluate that sort of risk going into next year?
I think equities still have some room to run. The Magnificent Seven, I think those are going to settle a little bit more. But you're going to see the rest of the S&P, more of probably see the banking sector, industrials do a lot better here going into the future. So it'll even out the S&P for more of the equal weighted S&P will do probably a lot better than just the Magnificent Seven that we've seen carry this market up for the last year or so, and then some. So I think we're going to see equities continue to do pretty well as people continue to look for yield. Yep. And the equity market is the place to get that. I don't think rates are going to go through the moon. They're going to slowly come down, so people will turn to equities. Sure.
To your point, though, it's fascinating because we also want to talk to you about alternatives. Your firm is the biggest buyer of convertibles in the United States. Why go into alt assets when you can just sit in the S&P or sit in the Mag 7 and have the bull market returns that I'm sure inspired your bull cufflinks you've got on
there we go.
today? Yeah.
Well, I think if most portfolios need some non-correlated risk. And what liquid alternatives or just alternatives in general provide that, right? So when you're looking for yield, they'll go into alternatives because it gives you a yield even when the markets are very volatile. And that's what a lot of liquidity that the alternatives do, especially for like our market neutral fund, that depending if the market's up, market's down, it usually gives you a steady, SOFR plus 350 type of returns. And a lot of people need that in their portfolio. Non-correlated risks, when you see markets that are continuing to be very volatile, and we'll see that. We're not going to go straight up. We're going to see some volatility. So liquid alternatives help take that and even it out in terms of the volatility.
When we talk about liquid alternatives, what exactly are we talking about in terms of alts there?
Sure, you're looking at stuff like hedged equity. You're looking at stuff at market neutral, which is hedged equity, convertible arbitrage, merger arb kind of combined. You're looking at long short type of strategies, and so those are all liquid alternatives. And then the alternatives are your traditional privates and private credit and private equity that we're also getting into. But we're doing it more in a democratization of the product and putting them in wrappers where mom and pop could have access to them in interval funds, which are something that's really, really hit the market, and it's growing type of wrapper, because you could have access, let's say in the private markets, mom and pop for $2,500 can invest side by side with great investors like Apollo, like Carlyle, like Blackstone. They have not had that access before. And now there's types of securities that you can get that access to everybody. And so people that want that extra yield, that are willing to give up a little bit of liquidity, can now get that and have access to it.
So operationalize that for me in our final minute together. Retail investors listening to this conversation, they want to get in on private credit. What do they do?
So there's interval funds. We have a private credit fund called CapEx, where it's really, really well diversified. It's just not mid-market lending that most of the credit funds have been in the past. It's real estate, it's real assets, it's distressed, it's the entire spectrum. So it's really diversified, and the returns are great. And we partnered up with an incredible manager called Axia. And so we provide some liquidity. There's gates of 5% per quarter, but there's no K1s, which is extraordinary because they really complicate stuff. You have to wait to get those to pay your taxes, and usually it's late and stuff. So it's a lot more accessible to mom and pop, and they don't have to put a big number in it. The smallest piece is $2,500, and you're right there. And a lot of the deals that we do, we invest side by side with the managers that I mentioned earlier.
I think it's a really good reminder to retail investors that it's not as complex as you might think to play private credit right alongside, the BlackRocks of the world doing 3 acquisitions this year on private credit expansion. Yes. There are opportunities for retail too. John, thank you so much. Really appreciate you coming to the studio with us. Thank you.
Great to be here.
Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith, he's going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks, of course, that you need to grow your money. Hey, on today's show, a deep dive into your portfolio. Bitcoin hits 100,000 US dollars. Is now the time to buy more, sell, invest in other crypto assets? We'll break it all down. And why 2025 could be the year of revenge quitting. We'll discuss with Glassdoor's senior economist. Plus, sticker shock at the grocery store, why you're paying 60% more for a dozen eggs this year compared to 2023. We'll discuss with the CEO of Pete & Jerry's Eggs. All that and much more coming up during today's show. But first, let's take a look at some of the market action. 90 minutes into the trading day, you've got major averages as of right now. After the opening bell, we were seeing some slight gains here, but as of this moment, as of right now, we are down, as you're seeing there on your screen. There you're taking a look at some declines. The Dow, the S&P 500, and the NASDAQ, fractional declines as they may be. We had seen some record closes for the major averages just yesterday. Plus, of course, and the big item, Bitcoin climbing above $100,000 for the first time as the crypto rally continues. Joining me now, Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Great to have you here with us this morning and back on the program, Joanne. Just first and foremost, let's start where we left off here and the crypto trade right now. How would you be playing it? What type of risk exposure makes sense for an individual's profile with crypto notching this new milestone?
Well, good morning, Brad. You know, the crypto trade clearly is one that reflects a lot of enthusiasm right now for risk. And in that way, it's a real signal as to what also might be going on in equity markets. And so overall, it's a useful sign that the risk on trade continues. You know, our focus for our clients is to invest in equities and also bonds. But, you know, crypto is its own asset class. It's probably best seen as an alternative to gold. It hasn't provided the sort of hedge against inflation that some people originally thought it would. In fact, if you look at the history, it is actually, you know, not correlated in the way you'd expect. So when you're thinking about crypto, you really have to think about it as a risk play. And there's a lot of momentum behind that, and that's proved to be very useful for those involved. You know, the other way to think about crypto is that in developing countries, in less developed countries, where the currency simply is not reliable, it can be a very useful way to transact. So we're seeing more of that. The high price of crypto actually creates a headwind for that use case. So it's sort of a mixed bag. And obviously there aren't, you know, fundamentals underpinning the value of crypto. It's really momentum and speculative risk. So, you know, investors that are interested have to recognize that's kind of what they're buying into here. And obviously the price has gone up a lot. And when you want to compare it to equities, you know, look at other things that have gone up even more. I mean, look at NVIDIA this year. It's up 193, 200% more over the last full year. So this year, NVIDIA has done better than crypto has. And at least with NVIDIA, you've got some real fundamentals behind that. So you don't want to look at it in isolation.
Certainly. And so as you're thinking about then in equities, some of your favorite places in equities, especially coming off of the record highs that we had mentioned, we had notched yesterday as well, in the S&P 500 notching its 56th record close. And then, of course, with the Dow Jones Industrial Average getting above 45,000 for the first time. All these things considered, where does it seem like there is still more room to the upside for equities, and where are the most attractive positions from your perspective?
Yeah, Brad. So obviously we've seen a lot of appreciation across the board. And, you know, beginning of the year, it was all the tech space and consumer in the big players. But then, you know, you notice about halfway through the year, things really started to broaden out. And the reason for that, and I think it's a reason that continues to be relevant today and into 2025, is that the broader economy proved to be stronger than than most people, I should say, expected it would be. And so we saw a rally coming from the fundamentals, better earnings, better sales, good solid profit margins that really helped carry the rest of the market beyond the big seven. And that's something that we, in pockets, can expect to continue. The economy remains strong. Inflation is under control. We have to, though, be mindful of how policies could change with the incoming administration. And instead of looking at how the whole market might react to that, it's really important to look under the surface because those policies will have more industry-specific and company-specific effects. So I think the time is really ripe to shift away from index investing and be far more attentive to how individual companies might do under these potential new policies.
With that in mind, it sounds like, looking at where the portfolio should also get defensive in the face of where there could be some volatility that does initiate on the back of policy from the incoming administration, as some of that is starting to be telegraphed right now. I wonder where those areas for a defensive mindset are really starting to brew for you and your team.
Yeah, so one area to look at is the consumer. We've already seen a real bifurcation of consumer health and spending, right? The lower end, middle end of the income distribution has really struggled with the cumulative effects of inflation, with prices really squeezing their budgets, and we've seen that come down to hurt the low end of the retail space, like a Dollar General, for example, and that ilk. And what we've seen do well are ones more in the middle, the off-price retailers like a TJ Maxx, for example. And so we still think that's a good place to hedge the risk to the consumer, whether it's from higher tariffs that may be coming down the pipeline, whether it's from constraints on immigration and foreign labor, which could drive up costs, particularly in agriculture or construction and that sort of thing. So, those companies, those retailers that offer value but quality, and I'd even push it up to a little bit to the higher end of like a Williams-Sonoma. They offer affordable luxury in their flagship stores and online, obviously, and then the Pottery Barn, which offers more reasonably priced furnishings and that sort of thing. We still see housing as a good opportunity, even though rates look like, they may not fall as much as folks hoped. But moving into a new home, a new apartment, creates the demand for the sort of thing that Pottery Barn sells. And we've seen that materialize in the quality of earnings that Williams-Sonoma has been delivering. So look at the consumer, look at the details. What is happening to their budget constraints, and where are they choosing to spend?
Joanne, thanks so much for taking the time, as always. Great to have the conversation here this morning. Appreciate it.
You bet.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Yahoo Finance's Catalyst co-host, Madison Mills. All right, Maddie, we normally talk about a few tickers here, but we got to zero in on BTC-USD because that's what's lighting up the Yahoo Finance platform right now. Hit 100,000. It's up more than 40% since the 2024 general election. So clearly, we're seeing some bullishness from investors after President-elect Trump's victory. Is there a chart that we should specifically kind of look at? And one of them is coin market cap. Honestly, I'm looking at the crypto fear and greed index here, a range from 0 to 100, and lower values really indicate extreme fear and higher values indicate extreme greed. And according to coin market cap, it's a gauge that really measures market sentiment. And one example is it could show whether the market may be undervalued, which would point to investors' extreme fear of crypto, or overvalued on the other end, which would be investors' extreme greed around crypto. And right now, we're checking this out, Maddie, it's currently at 85, so translates to extreme greed. That seems to match Bitcoin's soaring price level, but could it theoretically point to and come to some type of cool down sometime soon here?
It's a fascinating and important chart to look at. That's what investors always say, be fearful when others are greedy and greedy when everyone else is fearful. So are we at a psychological level of over 100,000 where it's time to take a little bit of money off the table here, take some profit, and then see what happens with regards to regulation? One of the key pieces that pushed Bitcoin over 100,000 was the Paul Atkins pick for the SEC, considered a pro-crypto candidate, but we haven't seen any legislation come through yet. This is all conjecture about the coming Trump administration. So seeing that policy actually come to fruition is going to be a critical piece of the Bitcoin picture moving forward. Having said that, Mike Novogratz, who has come on Yahoo Finance to talk about this, he has said, sure, you're going to see people taking money off the top when it hits this kind of a level, but long term, he's still bullish on Bitcoin.
Yeah. Let's also talk about some other coins, though, too. Bullish on Bitcoin is one thing, but every investor right now is hearing Bitcoin's broke 100,000. So if we look at some of the performance of other coins, I think most notably, there's easily the thought process that goes to Dogecoin. That's up over 350% this year. However, Ripple, XRP, that's up over 250% as well. Solana, that's up over 100%. So even more so, it seems like people are looking at Bitcoin as this rising tide, at least for sentiment, and now trying to figure out, all right, where else could there be either more affordable plays that people, for trying to look for some type of entry point into the crypto market, are trying to chart instead of going after the $100,000 coin that is Bitcoin right now?
When you're certainly not going to be able to buy a token if you are a retail investor. Who knows? If people are winning the lottery, maybe they'll be able to pull a Michael Saylor and get a full token, but it feels unlikely at this moment. It's smart of you to bring up XRP, Brad. I know you mentioned this in our morning meeting, the amount of growth that we've seen in XRP, one of those altcoins here that has been up 350% in the last 30 days. But we are seeing XRP coming off of those highs just a little bit here. You can see it's down just a little bit in today's trade. And as a reminder, of course, this is a 24-hour trade, but it points to this question about what is moving these altcoins. Is it a fundamental story or is it just vibes? And that is sort of the case when you look at some of the crypto-related equities as well, the likes of MicroStrategy, Robinhood, Coinbase, all up off the back of Bitcoin hitting 100,000. But is there a fundamental change at those companies? Not necessarily. So if you can learn to play the vibe, you can make a lot of money, but it's also a little bit something to be careful about.
You know, we were having this conversation with a guest earlier today on Morning Brief, talking about where coins are actually trading as more of a store of value versus, and Bitcoin, the prime case for a store of value versus some type of means of exchange or exchange and currency. Right. So all of that considered, we'll see exactly where some of the other altcoins start to get a little bit more fanfare in this near term.
And does it become a currency in the Trump administration?
Right.
If it's part of the strategic reserve, if we create that Bitcoin strategic reserve, then maybe it starts to lean in that direction.
Are there other coins that become a part of the strategic reserve too?
Right.
And that's a major question here too. Maddie, thanks so much. Appreciate it. Dollar General shares are trading lower after the discount retailer trimmed its annual profit forecast. This comes after Dollar Tree also narrowed its outlook yesterday. I want to bring in Sucharita Kodali, who is the Forrester Research Principal Retail Analyst. Sucharita, great to have you on as always. So which of these names is better for investors?
Well, they're both challenged for different reasons. We have Dollar Tree just announcing some pretty major executive shakeups, and that's never a good thing for a publicly traded retailer when the CEO has to step down for health-related reasons. Dollar General is also challenged. Both of these companies have issues related to the consumer just not being confident. They're heavily dependent on SNAP consumers, lower income consumers who are most stretched right now. So they're both challenged. Dollar General also tends to be more situated in rural areas, which makes it more competitive with players that are doing well, like Walmart. So if I had to pick, I'd probably say that Dollar Tree has a little bit of an edge, also because it's embarking in a broader tiered pricing strategy to try to bring some of its price points up.
Certainly. We also heard interim Dollar Tree CEO Mike Creedon address tariffs during the company's earnings call. I want to play a clip and get your reaction on the other side.
Back in 2018 and 2019, when we last dealt with this issue, we were able to mitigate the majority of the potential impact by negotiating lower costs with our suppliers, changing product specs or pack sizes, or dropping non-economical items. Today, all three of those options are still at our disposal. On top of those, we now have detailed plans in place to shift supply sources for most of our products to alternate countries. And multi-price gives us additional flexibility on our product assortment.
So it sounds like tariffs are already weighing at least on the minds of so many executives in retail right now, but how much will it really weigh on what investors and what analysts have come to expect of their performance too?
Well, I think it really depends on whether or not both of these dollar stores are able to diversify their supplier base, and in particular also diversify their mix. The more they get into consumables, which is the category that the lower income consumer is leaning into right now, there is less of the exposure to some of these tariff-laden markets. It is in the discretionary goods. It's all of the paper products or some of those items that are in seasonal categories that really have the biggest weight. And this is something that will affect anybody in this sector. I look at companies like Party City too, that are very vulnerable to some of these tariffs, particularly from China, because it's going to be very hard to find alternate suppliers because so much of that merchandise is coming from China right now.
So, I mean, it's not like the dollar retailers, Dollar Tree, Dollar General can really go out and put price promotions out there the same way that some of the other in the retail landscape can. So what are the levers that they can pull in this interim period? And it sounds like there could be some changes that really spell out shrinkflation potentially, even if we're looking at assortment and pack sizing as well. What are some of those levers that they can pull in the interim period?
Yeah, you called it out correctly. I mean, the truth is that they don't have too much leverage from a pricing standpoint, and that necessarily is going to cut into earnings. And I think that could even be worse in 2025. Because tariffs aren't there yet for them to have the softer speculation now is likely for other reasons related to the fact that consumers are just pulling back on discretionary items altogether. Now, what can they do? A lot of it is tricks with promotions. It's bundling products. It is having larger pack sizes so that you force consumers to purchase 2 or 3 of an item. And then there's a little bit less clarity around, kind of maybe what the per item cost is. So those are typically what we see when retailers have to have promotions, but they're not able to necessarily just discount an individual item altogether. There may be some introduction of some sort of loyalty program or some benefits that come from consumers that may shop more. That's typically a lever as well. And these companies have, for various reasons, not necessarily been big players in the loyalty space up until now.
Sucharita, thanks so much for taking the time here with us today. Appreciate it.
Thank you.
Coming up, everyone, Wall Street is digesting a slew of jobs data this week, which will culminate in November jobs reports tomorrow. We'll break it down with an expert after the break. The number of new Americans filing for unemployment rose by 9,000 last week. That's a slight increase that suggests steady cooling in the labor market. Daniel Zhao, who is the Glassdoor senior economist, joins me now in studio to discuss this. Great to see you. Great to have you back in studio with us. So just walk us through what we're expecting, what the anticipations are, and the broader trend that you're tracking within some of the economic data on the employment front this week.
Well, we are seeing that claims, even though they have oscillated a little bit, they are still consistent with a steady and slow cooling in the job market. So definitely not any sign of concern. We're not necessarily seeing like a surge in layoffs showing up in the claims data or even in some of the other economic data we're seeing. And I think as we head into the Friday jobs report, that's likely what we're going to see as well, some more steady cooling.
And so with that in mind, how does that really set up for the Fed going into next year from your purview?
Well, I think it sets up the Fed nicely in the sense that we haven't seen a more dramatic deterioration in the job market that some people just a few years ago thought was necessary to get inflation under control. So there definitely is some room for the Fed to continue to get towards this soft landing. It's still possible, it's still on the table, but obviously this last mile getting inflation back down to that 2% target is going to be difficult.
We got some ADP private payrolls numbers yesterday that really looked at the job stayers, job switchers calculus and a broader equation and where there are even wage gains still on the table there. I wonder how you're evaluating that data, and especially on the wage front, to really get a mindset of what 2025 could look like for the labor force.
Mm-hmm. Well, I think it's interesting because usually when the job market does cool down, you start to see that premium for job switchers decrease as people can't really find those higher paying jobs or those better career opportunity jobs in that cooler job market. And that is actually something we see in Glassdoor data as well. The share of workers who have had to settle for a pay cut when they switch jobs has actually increased over the last year. And that's particularly true in industries like tech that have seen a more dramatic slowdown as well.
It's interesting. One of the themes that you're anticipating for 2025, revenge quitting. I mean, we've gone from revenge travel and being able to talk about that and all the places that people are going to, of course, now revenge quitting. What is the anticipation there?
Well, to set the stage, what we are seeing with workers is that a lot of people feel stuck in their careers right now. So when we did a survey of professionals, we found about 2/3 of employees feel stuck in their careers, and that's leading to a lot of pent-up resentment, where there's this desire to grow their careers, and as a result of being stuck, there is a desire to quit as well, but not the opportunity because of the cooler job market. And so if people feel stuck, that resentment is going to build up. And once the job market does heat back up, I think a lot of employers are going to get caught flat-footed, not expecting a wave of turnover, a wave of revenge quitting, if you will, to start to take hold.
What are some of the top reasons for the buildup of that resentment that you were mentioning among employees?
I think it's really about career growth and career opportunities. Consistently, when we look at the Glassdoor data, that is one of the most important factors behind employee satisfaction. It helps attract people to companies and also keeps them there in the long run. Right now, there are a lot of employers who are cutting back on their budgets for raises, for promotions, and that sort of thing. And of course, if you need to do that to stay in business, to keep the financials healthy, that's a choice you have to make. But for employees, they're not going to sit there and get passed over for promotion year after year after year and not want to look for something new once the job market opens back up again.
It's remarkable within this data as well. You pointed out the side hustle culture, and it's fueling new paths to career growth. And, I've often heard about this, especially on the show and the side hustles, and especially now in the creator economy. My goodness, we had the CEO of Cameo on yesterday talking about how many people are joining the platform, earning on the side as well. And we learned about an inanimate object in a puppet that's earning $600,000 in 2024. We'll put that conversation to a different thing. But how many people and what portion of the population do you think is really coming around to having this ability to earn within the margins of their time and using that as a potential pivot one day?
Mm-hmm. In this Glassdoor poll we looked at, about 40% of of workers are actually pursuing a side hustle. And I think that that goes to show you that a lot of people are pursuing these non-traditional paths to success in a time when maybe the traditional career path or the traditional career ladder isn't really working for a lot of people. And I think that it's actually very encouraging, because not only does it allow people to experiment in maybe a lower stress way than just fully quitting your job and starting something new, but it also opens up those pathways down the road if maybe you want to start a business and really go all into self-employment and entrepreneurship.
Yeah, I'll send you my LinkedIn post about the puppet making $600,000. Daniel, great to see you.
Thanks.
Absolutely. Well, inflation overall is moderating, but one sticky item has been the price of eggs. Cue up the egg VO. 1 dozen grade A eggs currently cost around $3.37 in October. That's up over 60% from a year ago, according to the Bureau of Labor Statistics. Here with more on egg price concerns, we've got Tom Flacco, who is the CEO of Pete & Jerry's Eggs, here in studio with us this time. Great to have you.
Good morning. Great to be here.
Absolutely. Let's dive into this. What's really driving the cost year over year and the increases that we've seen in the price of eggs?
Yeah, I think the first thing you have to look at, Brad, is just to remember that the egg business is really two different businesses. There's what we call conventional, which is in the well, and then there are specialty eggs, which is what Pete & Jerry's and Nellie's are. The conventional eggs are a supply and demand driven business. So the number of hens out there are going to produce a certain number of eggs, and that's going to drive supply, which is going to end up driving the price or affecting the price on the shelf. That's set by an independent group. That has been affected by avian influenza, which has started in 2022, and we're still dealing with it. So we talked about this a little bit before. Since then, another 20 million birds have died from avian influenza, which takes, if the total layer population is around 325 million birds, 70 million in total have come out on this cycle. So when you take that much of a reduction, almost a 20% reduction in the supply of birds laying eggs, that's going to drive up price. Now, that's not the case for specialty eggs. For our eggs are actually about the same price now as they were a year ago for both Pete & Jerry's and Nellie's. Our eggs, we have a much different model. We have a fragmented model. We're in close to 300 farms and barns across the country. And so our eggs are not beholden to any one flight path of migratory birds. Avian influenza is spread by migratory birds. So that distributed model protects us. We also have, our farms are run by families, and there's 1 or 2 people on that farm doing all the work. So you're not bringing new people on and off the farm, which again is how that disease can spread. So touch wood, we haven't had the impact that those big conventional players have had.
So I guess from the broader industry, how far away are we from normalization of egg prices post avian flu, if that is in sight here?
So the thing about avian influenza is like any other virus. It mutates. It has become a little stickier. It's not going away as quickly. The last big bout lasted maybe about a year. This one is close to 2 years. 2015-16 was the last big bout. It went away for quite a while, and now it's come back. We're seeing it start to abate, but then every once in a while, then another farm is hit and another million or so birds are affected. So we're not seeing it go away anytime soon. Although this is the time that it ought to quiet down.
Sure.
So now birds have finished migrating, either now they've gone south, and we should start to see it quiet down, and then we'll see what happens in the spring if that comes back.
You've got an incoming administration that has been campaigning on a myriad of different talking points and rhetoric, but one of them that has emerged, at least on the food side, has been Make America Healthy Again. And I wonder, from your seat and position as an executive within this industry, what type of changes you're even anticipating needing to come down the pike as you're having discussions and representing a portion of the food pyramid.
Yeah, I mean, the good news is inside we refer to eggs as nature's perfect protein. It is the perfect little protein bomb that has a very small carbon footprint. It has a much better health impact than, say, beef or some other alternatives, and is certainly on a cost per gram of protein basis much easier on the wallet than, say, steak. I mean, I was literally doing a store check this morning on the way over here, saw a piece of steak for $22 that wouldn't, I don't think, feed 2 people. For $6 or $7, you buy a dozen of Pete & Jerry's or Nellie's, you feed your family and probably have some leftovers. So for us, it's around breakfast for dinner, and we think eggs have already been deemed a healthy food by the FDA. The cholesterol myth is debunked. Cholesterol has a lot of very important, very healthy proteins in it and vitamins, and so eating a whole egg is not going to raise. Matter of fact, there's somebody who went, I think he ate nothing but 4 eggs a day for a month, and I think his cholesterol went down.
Wow. Okay.
So when you think about eating healthier, it is about something it's healthy eggs, it's healthy hens, healthy eggs. We think a healthy planet. We think all those things are related. Our birds, by the way, because we're free range and pasture raised, that outdoor access is a really important piece to creating the healthiest egg possible. Birds that don't get outside, they're not going to have the access to vitamin D from the sun, grubs, bugs, things that chickens like to do. Yeah. They're just not as happy. We don't think as happy or as healthy. So caged and cage free. So we think if you really want to lean into this, right now the cost difference is less than $1 between cage free and free range. But cage free is not, the birds are not getting outside. Yeah. Free range they are. Right. So you're getting better animal welfare, more humane treatment of the bird. Yeah. And we think a better product on the backside.
Just lastly, while we have you, Tom, it's so interesting, the many industries that AI is going to have some type of role within. Could we really see that within food distribution, within egg production even?
Yeah. Talking about the other AI now.
Yes.
Yeah. The AI everybody else talks about. Yeah, so for us, we look at artificial intelligence as helping us really in two important areas. One is forecasting demand so that we can make sure we have the right supply online, and then the timing of that supply and as it comes on to be able to meet that demand. So AI can help us in both those areas.
Excellent. Tom, great to have you here in studio with us. Great to catch back up. Appreciate it.
Great to see you. Thank you.
Coming up, everyone, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's Market Minute. A flat day on Wall Street so far, with the S&P 500 and NASDAQ teetering near the flat line. Taking a look at the Dow, down right now about 0.2%. 3 trending headlines we are watching today. A choppy day for crypto miners as stocks initially got a lift with Bitcoin rallying past the $100,000 threshold on news of Donald Trump's pick to lead the SEC. Some of those gains now being reversed. Investors cheering the latest results from charge Point Holdings. That stock is popping after the company reported better than expected sales in its most recent quarter. And shares of Salesforce reversing some of those gains after getting a big boost on positive earnings results. The company raised its revenue guidance for fiscal 2025, citing strong demand for its AI offerings. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
Welcome back. Let's send it down to the New York Stock Exchange, where Yahoo Finance senior reporter Brooke DePalma is standing by. Hey, Brooke.
Good morning, Brad. Bath & Body Works just had a strong Q3 report, and now they're gearing up for their annual Candle Day. And I'm joined by Gina Broswell. She's Bath & Body Works CEO. Gina, good morning.
Good morning. Thank you for having me.
Of course, I want to start with something that's on top of retailers' minds at large, and that is tariffs. You say you have a big advantage here. Why do you say that?
Yeah, for years now, we have been doing a lot of nearshoring and onshoring, and really pleased to say that today, 85% of our production manufacturing is in North America, the majority of which is really right outside our headquarters in Columbus, Ohio.
Would you say that tariffs then are a benefit against your competition?
Well, I wouldn't say that so much. We do it for two reasons, really. One is minimal exposure, but the other reason for having onshoring is just flexibility with speed and agility. And for us, that's part of our differentiated model, is to be able to get our products in the stores in weeks rather than months. So it's sort of a double benefit.
Now, roughly 10% of your products or sourcing does come from China, Canada, as well as Mexico. So when you think about that, how much of an impact will this have? Will you have to then raise prices?
Well, we do a lot with our supplier partners, very collaborative. It's a group of suppliers called Beauty Park, and we work together to, mitigate any sort of additional costs, as we have been doing for years and years with them. So we would seek to mitigate that, and if there were anything, of course, we would, pass on a modest amount. But honestly, I'm very comfortable with the value engineering that our team does to be able to mitigate that.
So Best Buy CEO does say that consumers will brunt the cost of it. You're saying not so much in your case.
Well, we offer a compelling value proposition. So for us, it's all around the absolute highest quality, the most value, which includes convenience and experience, but at an affordable price. And so that's very important to us to make sure that we're meeting the customer mindset where they are.
Yeah, perfect segue to your big annual event, biggest promotion perhaps of the year. It's your annual Candle Day. Yeah. How are customers thinking about promotions and overall this holiday season?
Well, we are on the eve of Candle Day. It is our biggest day of the year. And, I'm so excited to see how the stores are going to light up with all of that. We usually have customers lining up at 6 a.m.
Barricades?
Literally lining up with matching outfits. We have a fandom that is like no other brand I know. And so to see that sort of excitement, and we're also celebrating a 25th anniversary for Winter Candy Apple. So we have fragrances that people love for years and years and years. And so when it comes to just the shopping spirit, the 30,000 seasonal associates that we hire to be able to keep up with the shopping demand, bring all of that to life with our customers. So,
are customers really focusing in on these promotions days? Are they holding to buy out until then, or are they mixing their basket with full price items as well?
So we have been seeing a value-seeking customer for several quarters now. And as I said, value isn't just about the lowest price. And we were very excited. We're America's most loved candle. And what that really means is the leadership credentials that we have. It's the best fragrance throw, it's the 25 to 40 hours burn time, it's a clean burn and so forth. So we find that when customers seek value, they're not necessarily seeking the promotions per se or the discounts, but rather the full quality. And so that's what we bring to bear. But yes, they are choiceful. They are discernible in terms of what they put in their basket. But we've been navigating successfully this macro environment for some time now.
Yeah, I do quickly want to hit on the share price. Year to date, shares are down roughly 14%. What's your message to investors here?
So we are heads down executing against a long-term strategy, and it has been working from the standpoint of, I think, this third quarter. If you adjust for the calendar shifts, which is, of course, you have to remove the 53rd week and the shorter shopping season, we have sequentially improved our top-line sales throughout 2024.
Very quickly, top challenges against your consumer right now, and where is your consumer when it comes to the income cohorts?
So one of the things that we have a huge loyalty program with 38 million active loyal users, and that allows us to sort of look at demographics of all kinds, socioeconomic. We've actually not seen any discernible difference on socioeconomic in terms of their behavior and their ability to shop with us. And I think that speaks to the fact that we have a wide range of price points. You could literally go right now and pick up a beautiful gift set already wrapped from $10 to $50. And so really it's more around meeting the customer where they're at and less about sort of the socioeconomic segments. And we certainly don't see it in our data, so we're excited about that.
Gina Broswell, Bath & Body Works CEO, thank you so much for joining us.
Thank you for having me.
Happy
holidays.
Happy holidays.
Thanks, Brooke, for that interview. Really appreciate it. All right, everyone, let's take a look at the major story that we're tracking here today within the crypto markets. Bitcoin holding above 100,000 right now, and it's really the move over the past 24 hours here. How about I circle it over here? That 6% move that you've seen equates to about $5,600 and has pushed us above that $100,000 marker. And as we're taking a look over this past year-to-date move that we've tracked, of course, much of that rise higher has really been sparked post-election. Now we're getting even more news and inclination about how crypto thinkers and traders and hodlers out there are anticipating the entire environment to potentially shift next year with a more crypto-friendly SEC. More of those picks being made known, and now you're seeing us cross above that. But there's still a lot that has yet to be delivered. We'll see exactly what that looks like over the course of next year. But as we're thinking about some of the other elements of the crypto landscape, let's take a look at other cryptocurrencies as well. This is a past 1 month view here, and you can see Ethereum has risen by about 60% over that period. Bitcoin is not the biggest outperformer. Hey, take a look at XRP. That's been up over the course of the last month by 360% here on the day, seeing a little bit of a give back. Of course, this is a 24-hour look at Ripple, but all these things considered, a ton of green here as the broader Bitcoin ship has been perhaps rather a tide that's lifted the rest of the boats here that we've been tracking within the crypto landscape. And then just lastly, here's a look at the crypto stocks. Let's take a look at those intraday on this new record day for Bitcoin at 100,000 and above 100,000. And as of right now, you're taking a look at more green on the screen than red. However, pulling up a little bit of the caboose here, you've got Argo blockchain, but leading the pack here up across the board. You've got an 8% move higher in the 9 and some of the other crypto-related stocks as well. Coinbase, for all those that are keeping score at home, as of right now, it's up on the day by about 0.3%, giving up a little bit of the ground that we had seen earlier in trade. A lot of young people aren't very confident in their money knowledge and avoid risk, according to a Wallet Hub survey. 57% of Gen Z think savings accounts are the best way to invest their money. Here with some tips to get Gen Z interested in investing. We've got Ashley Fox. She is the CEO of Amplify. Great to have you back in studio with us. And so, how can we make sure that the future generations are confident about their investing strategy, and where can they potentially start to put toe in the water or put some skin in the game?
So when I think about investing and building wealth, you cannot save or work your way to wealth. So we have to start investing. When we think about our buying power and spending our money, these companies are getting bigger and bigger and bigger. What if we start to own a piece of these companies? And as the Gen Z population continues to go into the workforce, spending their money is only going to make the economy grow, but how can we build our wealth with it? So opening brokerage accounts. Yes, saving is great, but what about when they get older? What about when they're thinking about retirement? What if we start retiring early and we have our money working for us? So it is extremely important that we are not just relying on savings accounts, we are also investing in the stock market.
And so what are you seeing in terms of Gen Z and how they're doing their own investment strategy planning? Where are they performing well, and where are some of the pitfalls that you're noticing as well?
I'm noticing a lot of Gen Zers are really good at attempting to make money. Okay. Right? They're finding different ways to make money, whether it's online in different ways.
That's not a bad thing.
No, I love it. I love it. But what else?
Yes.
Right? We're putting in the effort, we're putting in the time, we're putting in the energy. How are we putting our money to work? And if we think about the school system, we're not taught how to invest. We're not taught how to manage our money. We're not taught how to understand credit cards. So we're good at taking out debt. We're good at shopping. We're good at creating content. But what about investing and building that wealth so that we can create passive income? What about dividend investing, right? What about growth stock investing so that that money, while we're working for it, it can also work for us while we are sleeping?
What are the top strategies that anyone can be putting into effect with the last few weeks of the year to set themselves up even before that New Year's resolution when it comes to their investing and saving strategies?
The first thing I would say, you have to get a brokerage account.
Okay.
Because having a savings account, having a checking account, we're good at that. We have to start setting money aside automatically. So the first thing I would say, open the brokerage account and pick a small amount of money every 2 weeks that you can set aside. Nothing too big that forces you to feel like you're about to overdraw your account, but something that can be set aside consistently and automatically so that you're comfortable and confident. I always tell people at Amplify, the people that we're working with, you can start with $20, right? There are brokerage accounts now that allow you to buy fractional shares. What if we $20 our way to $1 million? What if we don't have to work until we're 50, 60, 70 years old, but we're building now while we're young, we're starting small, and it's compounding over time. So I would say get the brokerage account open, set small amounts aside automatically so it happens without you even thinking about it, but also build a strategy. Think about at the end of 2025, what do you want life to look like? What kind of money do you want to have coming in? How big do you want your portfolio? How much passive income do you want to have coming in? And start moving with intention. And every single quarter in 2025, increase that automatic deposit just a little bit so that you can train your mind to grow as you grow as a person.
I want to marry two different segments together here, and we were talking earlier with Glassdoor's senior economists just about what they're noticing within the mindset of the workforce and where there could be a trend that takes place in 2025 of revenge quitting because there isn't the upward career trajectory. But I'm going to take the other side of that. Say you finally come into that promotion. Say you finally are able to say, all right, I'm getting a new raise. What is your mindset that you need to take on the second some of those things start to fall in line?
So if I'm being honest, I know just whether you are a Gen Z or a baby boomer, anyone, when you make more money, you create a way to spend it, which is fine. Acknowledge the fact that you want to spend money on other
like
things.
A book, yeah.
So acknowledge that.
Yeah.
But also understand to sustain that lifestyle, to always be able to put yourself in a position to get the things that you want, you also have to set money aside so that at some point, when you don't have that promotion, at some point where you choose to leave that job, you have accumulated wealth that has been set aside, that has been grown, because it's great to work. It's great to build a business, right? But what about when you don't want to anymore? What about when you want to travel, when you want to do things? What if you don't have to utilize your physical energy to be able to do the things you want to financially. So as you make more, you invest more and pay yourself first, because even though we like to spend, we're giving that money to some other company, to some other individual that is making their money, fine, but what about you?
Yeah.
Because you're going to decrease your net worth every time you spend. So what if we spend and invest? I always say it's not this or that, it's this and that.
We got a little bit of time left here. I'm going to throw you one more, and we didn't talk about this in advance at all, so I trust that you've got so many strategies here. We're in peak spending season, basically.
Yes, we are.
How can people make sure that they're spending smart, even as they are going out, balling on a budget perhaps, and making sure that they check off everyone on the list?
So I always say, start considering to own stock and who you give your money to. So inside of our Wealth Builders Community app, our membership-based platform, and Amplify, we have a I Own It challenge, where we are investing in the companies that we're spending our money with. So start thinking about parents, where your children, what they want for Christmas, what do they want for the holidays. So I have like a 7-year-old niece. She loves Roblox, she loves YouTube, she loves Target. What if we take a second and find out, well, how much does it cost to own stock in Target, to receive a dividend from Target, to invest in Google? So take into consideration that yes, we're gonna spend money for our children and for our families, but what if we give the gift of wealth? What if we buy them the gift, but also buy them a share at the same time? And really challenge yourself during a time where the entire world is spending money. Let's look at earnings at the top of Q1 2025. Think about all the money these companies are gonna make, and what if they grow because you spent money, but you grow with them because you spent money, but because you also invest. So it's, again, doing both. Just, you have to train your mind to become a wealth builder, to operate in that capacity. And yes, we're gonna spend, but we are not going to make these billion-dollar businesses even richer and not get a piece of the pie.
Ashley, thanks so much for joining us in the
you.
studio. Excellent advice as always. From album sales to book sales, Taylor Swift is the ultimate chart topper. The music superstar self-published The Eras Tour book, sold over 800,000 copies in its first week, according to Circana Book Scan, making it one of the best-selling nonfiction book debuts ever. Target is expected to get a boost from the book's success as the exclusive seller, and they've set their hopes high, producing 2 million copies for the first print run. That's according to the Wall Street Journal. So, if you're looking for a gift for the Swifties in your life for just $39.99, you could get them this 256-page work, which includes more than 500 images of their favorite pop star. A programming note in this week's episode of The Money Glow Up. Host Tiffany Alashay speaks to Michael Learsh, who's the head of advice and planning for wealth and investment management at Wells Fargo. Learsh offers insight for managing financial stress, budgeting, and why people so often find themselves financially strapped during the holidays.
So when you think about holiday and stress, I do want to normalize it again, Tiffany. So it is normal. The easiest way, though, to tackle it is to talk to other people.
Okay.
And talk to other people you trust and come up with ideas together.
Okay.
So I just want to highlight that accountability partner, that conversation, being open and honest. In the United States, we have done so many studies. It's just so hard for people to talk about money and finances and financial stress. It's really not great for anyone in the U.S. So let's open the conversation like you're doing, and that's why I admire you so much, Tiffany.
Thank you.
And you can catch Money Glow Up every Thursday, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. A new survey from CNET shows 66% of U.S. adults are concerned about falling victim to scams this holiday season. And more than 7 in 10 respondents have already taken actions in the past year that security experts deem dangerous. You've probably seen headlines about data breaches over the years, either via online or little notice in the mail saying your personal information may have been compromised. And one of the best things that you can do in that case is freeze your credit, which restricts access to your credit report and can prevent bad actors from spending money on your dime, opening a new credit card in your name, or applying for a loan, et cetera, et cetera. This CNET survey reveals only 27% of U.S. adults said they froze their credit following a breach. To freeze your credit, you can contact each of the 3 major credit reporting agencies, Equifax, Experian, and TransUnion, or do it online through their sites or apps. CNET also found 41% of adults are using the same password across multiple accounts within the past year. We're still doing that? That can be a big no-no. But as people shop this holiday season, they are taking action to protect themselves. 84% are taking some sort of action, with 48% buying products only from reputable sites. 37% strengthening their password hygiene. Side note, that's your cue to get rid of your mom's 0000 passcode. And 31% are checking the website security before making a purchase. So, save this video to keep safe from scams this holiday season. Let's do a final check of the markets as we are just about a few minutes away from noon Eastern Time. We're mixed as of right now. The Dow and the S&P 500 in negative territory. The NASDAQ flat, just barely to the upside. And that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.